This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Wednesday morning. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, hi, morning.
Hi, good morning, Prashant. Good morning, Nigel. Well, the market has, it's all set to see a bit of a gap down considering what we've seen globally. But once again, this has been a buy on dips market. So hopefully that's something that will play out.
I agree. The texture of the market will be tested today. So let's get straight to the action.
And the problem, once again, like yesterday, is global. It's not local. And, so I think we'll have to begin there. On the outset, I'd just like to say what I said yesterday, which is that, perhaps you got to look through, and I said this yesterday, that maybe just look through the day. And I think it kind of makes sense today as well. Because it's not as if locally things are looking bad or poor or anything of that sort, although you can fault flows not coming through from the foreign side. But otherwise, there is enough masala in the mix, so as to speak, to keep the markets excited here, right? But globally, things are looking a little down and out, and I'll explain why. So equities overnight in the US were down 1% on the Nasdaq, about 0.75% on the S&P. Dow actually was down about 1% as well. And the problem is largely US rates, which was basically what we woke up to and pointed to yesterday as well. So the 10-year in the US is up 20 basis points in the last 5 sessions. So day before yesterday, 10 basis points. Last night, it went up 5 basis points. We're at 4.36%. By the way, the real rate, right, ex-inflation, that in the US is now, actually last night, it's around the 2% threshold. Last time that happened, it caused a bit of a move on the downside as far as US risky assets are concerned, like equities. Now, the problem for many, of course, and the reason why yields have moved up is inflation, right? Many have been pointing to, and those who are focused on the inflation reaction function from the Fed, that inflation, wages, etc., are coming in very sticky. And that's true because lately, all the data points have pointed to that. Notwithstanding the fact that Fed Chair Powell in the last 2 or 3 weeks, twice over, has sounded dovish, right? One after the FOMC meeting, the other late last week. But data is pointing to the other direction, and markets seem to be watching that and perhaps sort of making the case that, Fed also will follow data eventually, irrespective of what they will say. So last night you had the US job openings which came in, and that indicated a continued strength in labor market. The added sort of fuel to the fire from last night and over the last couple of days is commodity prices. So oil prices, for example, are up 2%. We're up 2% last night. They're at about $89 a barrel. Now, stronger commodity means higher inflation. That also cuts through this Fed cut narrative. You also had, a voting member of the Fed, which is, Fed's Mester, who sounded dovish but essentially favored. She favored higher for longer in terms of rates trajectory. Now, this is again something which markets are watching out for. Distill all of this down. Forget about May, forget about June. July, right? What are the markets pricing in? What were the markets pricing in for the Fed to do in July? 100% cuts, odds of a cut in January when we started this year. In July, that number now stands at 31%. This is probability and market pricing of what the Fed may do in July, right? So, the odds of Fed cuts are being priced lower and lower. Now, gold, gold, of course, is at a new high, 2250. Silver, by the way, silver prices also went up about 3% yesterday. The other sort of hit to the market was Tesla. And Tesla, of course, has underperformed and has been kind of moving sideways for a while, but last night was down 5%. Deliveries there were a disappointment. Actually, they came in even lower than the whisper number. So where does all of this leave us? I think it leaves us in a place where we will see a lower gap up, and then we've got to figure out levels. So on the upside, which I think we can sort of rest assured, maybe not today, it won't come into the picture today, stands at 22,526, right? You just see the last 4-5 sessions, the markets got to those levels and sold off. We crossed it, made a new high, but we've not had a close above it. So only a decisive close above the 22,526 level will give us sort of upside targets, and some of those numbers are on your screen. More importantly, on the downside, the supports come in at 22,300, which from yesterday's close, I think is about 150 points away. there's a 40 hourly exponential average, and then the 20-day moving average is 22,200. On the Nifty Bank, the levels are on your screen. Supports come in at 47,217, which is the 40 hourly exponential, and then the 20-day moving average, which is 47,078. GIFT Nifty will come up on your screen. It's indicating a slightly lower start, about 100 points or so, 0.5% or so lower start. That's become a little larger, 125 points. Should you immediately, if you get a 125-point dip, should you immediately go and buy the dip? I would say, given the fact that yields have consistently been moving up in the US, oil prices are hitting newer highs. I mean, it's kind of worth waiting and seeing if the global picture starts to unravel a little bit more. If not, I mean, the trade, of course, has been to buy the dips, and that will give you the opportunity lower down at the 22,300 or the 22,200 kind of levels. But this morning, it's going to be a lower start. Sonia.
Oh, absolutely. It will be a lower start because lots of things are against the market's favor, right? The US markets actually closed lower for the second straight day. And overnight as well, you had a steep correction come into the US market. So the Dow was down about 400 points. Now, the Indian market texture, we've covered a lot about how global markets are under pressure, but the Indian market has been decoupling from the US markets for a while. So the texture in the Indian market has been a very, very strong buy on dips, and that is something that could continue. It's important to remember that the gap down opening is likely because of the US markets, but this gap down opening has nothing to do with any domestic factors, and hence maybe you could see the markets buy the dip. Now, the Indian markets have been running on very strong domestic money. So DII is once again bought in the cash markets yesterday. They bought about 1,950 crores. And put together, it's been 10 trading sessions that we've seen buying come in from the domestic institutional investors. So that's important to point out as well. So the big question we're asking is, should we be prepared for a pre-election rally? Now, there are many things that suggest that there could be a pre-election rally playing out. As we pointed out yesterday, the political events in the recent past, the macro events with the strong GST collection, all of that put together has been giving our markets a lot of strength. The Nifty is up 3% from the March 20th low as well. And a couple of things, yesterday we were speaking to Manish Sonthalia. He did mention that even the valuations of this market are quite reasonable at about 19-20 times, which gives us more legroom on the upside. So yes, today there will be a gap down opening, but will that dip get bought? That is the big question. I assume that the dip could get bought because that's something that has worked in the past.
Well, and that's work, right? The buying the dip has worked,
Yeah.
but I think the 20 DMA becomes very, very important for today's trading session. Let's run you through the top cues then. The troika is not in favor. That's yields are higher, Brent crude prices are higher, and the dollar index as well is fairly stable. So that's not great, and that's why you have the GIFT Nifty that's under pressure. What did the FIs do yesterday? Well, they added some long positions, and now the short positioning has come down to just 15,000 contracts. Remember, just a few weeks ago, we were seeing those net short positions at close to around 90,000 contracts short. The net short positions now have come down to just 15,000 contracts, and that's the lowest we've seen in nearly around 2.5 months or so. In percentage terms, it's at around 53%. One strike that's been very, very active in the last few days is the 22,500 call. It added a good amount of open interest yesterday as well. The premium's at around 65 rupees. So that's telling me that the bears want to fight for this 22,550 to around 22,600 odd mark, going by that data point out there. The reference point on the downside, if you're looking to buy the dip, in today's trading session, then your stop loss comes in at around this 20 DMA. That's going to be a very, very important mark. Till this 20 DMA holds, I'll say that the uptrend is pretty much intact. This is the near-term support zone that you're looking at. For today's trading session, the Nifty Bank has its weekly expiry, so that'll give direction. And given that global Q is a little bit subdued, you're looking at some of the inward-facing names, and maybe the banks could be in focus as well. The broad range that we're looking at on the Nifty Bank is earlier it was in this band of around 46,000 to around 47,000. Now it appears it's in that band of around 47,000 to around that 48,000 odd mark. So that's going to be important as well. The Nifty Bank holds a key for today. For starters, we start off in the red with the GIFT Nifty suggesting a bit of a gap down. That dip needs to get bought into at some point of time. And if that's the case, the 20 DMA comes into play. That's your stop loss for the day.
All right, Nigel, thanks very much for that. Well, before we go any further, let's quickly tell you what's lined up here in the first half hour of the show. We get you updates from markets across the globe. Jahangir Aziz will be with us at JP Morgan. We'll discuss the global setup. That's going to be interesting. We get you a list of top 10 stocks for the day with our research team. And then at 8:30, we have Deven Choksi joining in with some fundamental stock check.
All right, let's also get you some money market views now for the day on the rupee. Kunal Sudhani of Shinhan Bank says that the US job openings slightly exceeded expectations while the factory orders show robust growth, impacting treasury yields. Many Fed officials see 3 rate cuts as reasonable this year. Higher Brent crude prices continue to act like slow poison for the rupee. He sees 83.28 as a support for the rupee while 83.50 is a resistance.
On bonds, we have Neeraj Gambhir of Axis Bank who says that last week the Indian 10-year yield traded in the range of between 7.03 to 7.1%, lower than expected. G-Sec H1 borrowing calendar led the bond yields lower. Fed Chairman Powell's hawkish remarks in his Friday speech suggested that FOMC was in no hurry to cut rates. However, higher than expected US ISM manufacturing data led US Treasury yields higher. Consequently, domestic bond yields sold off at the start of the financial year, with the 10-year here at about 7.1%. He expects the 10-year here to be in a range of between 7.05 to 7.15%. All right, well, Jahangir Aziz is with us, Global Head of Emerging Market Economics at JP Morgan. Jahangir, great to have you with us here on the program. It's been a while, so good to see you here. So what's the sort of latest setup and how are expectations moving, given that data perhaps in the US is coming in stronger, but the people who make policy are sounding dovish, starting with Chair Powell. So will the markets believe what they're saying or what the data shows us?
Look, the data has been doing broadly what the global narrative has been from the beginning of the year, that growth is going to hold up reasonably well. I'm talking about the US economy. I think the surprise bit has been that the growth is holding up much better than we thought. And at the same time, you have seen, the impact of the rate hikes getting muted by the fact that the financial conditions in the US, and I'm not talking about the last month or so, but financial conditions in the US, let's say compared to where we were in September last year, has eased quite a bit, so that the fear that there is still lingering a dampening effect from the rate hikes on the economy, that I think is fading away. And at the same time, you've had very strong immigration flows, and you have had very strong productivity growth, which has kept profitability quite high and has delivered very strong employment numbers without actually leading to higher wages or creating spikes and reducing unemployment too sharply. So I think you are going to see a growth actually deliver upside surprises. It has already surprised us probably for 4 or 5 straight quarters. It's probably going to continue to surprise us on the upside. You've seen the ISM numbers. They are now manufacturing joining the service sector recovery that has been going on for quite some time. I think the concern obviously is inflation. And I think the concern isn't so much that inflation is going to spike back up. Core PC has been reasonably well behaved. It's just that last mile problem where can US get inflation down to that 2% core PCE number and sustain it there? I think that's where the market is concerned with. But as far as the policymakers are concerned, you should listen to Chair Powell or you listen to the officials around the Fed. Chair Powell's view has been guiding us, I think, to a June rate cut. That's what we have. Probably about 3, maybe a little bit more, but 3 is what we have in our baseline. The officials around Chair Powell are guiding to higher for longer. No one really knows what higher for longer means. Does it mean staying where you are for a longer period of time, or does it mean another 3, 4 rate cuts, and that too would be construed as higher for longer? So I would say that you tend to listen to Chair Powell more than the people around Chair Powell, and I think we're still on track for a June rate cut with about 3 rate cuts this year.
Okay, June rate cut from the US Fed and 3 rate cuts this year. Got that. What about the RBI, Jahangir? On Friday, we have the first meeting of FY25. I mean, no one's expecting any move on rates, but do you think the stance could change this time? Are we headed for a surprise?
No, I don't think so. I think, look, look, if you're going to buy into an 8.5% growth rate, what change of stance should you expect? First of all, you still have pretty sticky, not core inflation, but you have pretty sticky headline inflation. We expect headline inflation to go down to near the a corridor over time. I think if you have a June rate cut, the earliest, given the very narrow differential with the US I think the earliest you would see is probably a July rate cut, but it's going to be a very shallow rate cut. You can't have, both 8.5% buy into an 8.5% growth rate and then say, I want to have deep rate cuts.
Hi, Jahangir. Good morning and good to see you. And I wanted to ask you about the Chinese economy. It's posing a couple of problems, not just from an equity market standpoint that maybe they take some bit of the flows. The problem is that, with the Chinese economy rebounds, it gives inflationary concerns yet again. How do you see this panning out? Because you're seeing commodity prices again perk up.
So I don't think that, the linkages between Chinese growth or Chinese M2 growth or Chinese TSF growth, what used to be the thing that we used to look at and then say, well, commodity prices are going to do this, hasn't really panned out since the pandemic. Look at 2022, look at 2023, when 2022, growth seriously disappointed in China when China was still under COVID lockdowns. In 23, growth did pick up in the first quarter, but still disappointed given what the market consensus was. And then you look at import numbers of Chinese commodities. They didn't move an inch either in 2022 or in 2023. So I think that one needs to divorce oneself away from this idea that we have been used to, that Chinese growth, whether it's driven by infrastructure or real estate, is necessarily is linked to Chinese demand for commodities. China has been stockpiling commodities as separate from its growth needs, and I think we expect that to continue. So I don't really think that changes in Chinese growth, a rebound in Chinese growth, or a collapse in Chinese growth is going to matter for commodities. What will matter for commodities is that Chinese stockpiling strategy is going to put a floor to prices and most likely put a ceiling to prices, because when prices fall below a certain floor, they will come in to buy it. When prices move beyond a certain ceiling, they're going to get out of the market. So I think they're going to keep this movement in commodity prices range bound, but has little to do with the volatility or changes in Chinese growth. It hasn't happened for the last 2 years. I don't think in 2024 we'll see any change in their stockpiling strategy.
Jahangir, yesterday there was an article in, I think it was Bloomberg. It basically said, and I quote, investors are unwinding the buy India, sell China trade. Unwinding that trade. And it kind of had quotes from some large asset managers around the world. Are you picking that up? Is some of that going to happen? What's your sense?
I did not pick on the first part of the strategy, which was short China, long India in the first place.
No, not short. Sell China. I mean, that's happened, right?
The first part of the last 2 years was short China, long India. Now you're saying that people are moving to the other side. I do not buy into the first part, so I'm not buying into the second part. Look, there is an issue with emerging markets, and the issue is that emerging markets, if you leave aside fixed assets, so if you leave aside sovereign debt, if you look at the rest of emerging markets, in the equity space particularly, there is a sheer shortage of risky assets. China was the only one that had these $1 trillion market cap companies. You take China out of this mix, then in the rest of emerging markets, you do not have places where you could put in reasonable amount of large capital inflows, i.e. that the absorptive capacity of emerging market equity markets has been very, very shallow. If you think about market cap in India, market cap in India is about $4 trillion US. You have a company in US called NVIDIA whose market cap is $3.5 trillion. So I think size matters in these things. I think emerging market equity markets have a problem of absorbing large amounts of capital. You put in $10 billion in a market like India over a month, and suddenly everybody's screaming over valuation, and therefore the trade gets stopped up. I think that's what's happening in this world, in this shift towards, bottom. I don't know how you describe it, but you're winding down that trade. I think it's simply that China had that equity capacity. The other emerging markets don't have the equity. Equity markets do not have the capacity. You can't put in more than a certain amount of finite money in non-China emerging market equity markets. We have done that. Now we are looking at concerns of overvaluation. China clearly is undervalued, and that's why people are making that argument. But as I said, I never bought the first part of the argument. I'm not buying the second part of the argument.
All right, Jahangir, we'll leave it at that. Thanks a lot for joining in and speaking to us about what to expect from the US Fed and the Reserve Bank later in the weekend month. Let's slip into a quick break. On the other side, our list of top 10 stocks with our entire research team. Don't go anywhere.
Sir.
All right, welcome back. Hope you're having a good morning so far. Looks like the bulls are not going to have a great morning, given that the implied opening is suggesting a cut of 120 points. But we'll take it as it comes because this market has pretty much been a buy on dip. So hopefully that should be the case even in the next couple of days. But Vamakshi is joining in to tell us why you need to watch JSW Energy this morning. Vamakshi, good morning.
Well, good morning, Sonia. JSW Energy on our radar because the company has launched a QIP. They are looking to raise 5,000 odd crores, and in fact, this could lead to nearly 6.27% of equity dilution. Sources tell us largely these funds will be utilized towards repayment of outstanding borrowings, investment in JSW Neo Energy, as well as for general corporate purposes. Now, keep in mind that we had indicated earlier that our sources were suggesting that Qatar-based prominent investors were eyeing a stake in JSW Neo Energy. The floor price of this QIP has been determined at 510 rupees per share, which when compared to the closing price yesterday is at a discount of almost 6%. But more importantly, our sources tell us that the indicative issue price for this QIP is at 485 rupees per share, which is even lower than the floor price. So on the back of that, expect the stock to open lower today.
All right, thanks a lot for that, Vamakshi. Well, I'm tracking Ultratech Cement. When there was a new player, a formidable player that came into the cement industry, people said Ultratech is going to have it tough. Well, they've upped their game and they're proving that they are the king of the cement industry. Now, overnight, they've gone ahead and commissioned 2 new greenfield projects in Tamil Nadu as well as Chhattisgarh. And also in the last 12 months or so, they've commissioned capacities of around 18.7 million tons. So they have kept at it. The total capacity has now moved to around 151 million tons. And they're saying, if you put it in a global context, well, that's more than what the United States has. And it's 80% of what Europe has. So big capacity is what they're sitting on of around 150 million tons. The expansion trajectory as well, they put it into context. They did the first 100 million tons. That's Aditya Birla Group in around 36 years. And the last 5 years, they've added 50 million tons. So that's the kind of expansion that they've done. And they've outpaced the industry by a mile. And they're not yet done. They're at around 151 million tons. They're adding around 35 million tons. And also, you throw in their Kesoram Industries, they say that they're headed to around 198 million tons. And they're committed to that capex of around 30,000 crores odd. So Ultratech Cement, the undisputed leader of the cement in pack. And that one, in fact, should open up in the green.
Okay, we'll watch out for that one. The last 1 month, Ultratech Cement has not done much. So let's see if it starts to pick up now. But Vamakshi is joining in to talk about Z Entertainment and why you should be watching that one. Vamakshi, over to you.
Well, Sonia, the stock is expected to open higher today. Sentimentally positive news coming through for this counter. After the Z-Sony merger fallout, the management has taken several measures for cost rationalization, and the latest one being that MD and CEO, Mr. Puneet Goenka, has taken a voluntary 20% pay cut. Now, keep in mind that on March 29th as well, the company had decided to prune its technology and innovation center by almost 50% to achieve a cost-effective structure. Important to note that TIC incurred an expenditure of almost 600 crores in the last year. And in fact, the company also reiterated that they will now be focusing on return on investment, specifically from TIC. All of this is a part of the monthly management mentorship program, that is the 3M program that they've named it. This was institutionalized on March 26th, and in fact the objective of this program was to achieve key performance metrics, which includes the targeted 20% EBITDA margin. So all of these measures leading to cost rationalization for Z Entertainment. Expect the stock to open high on the back of this.
Okay, thanks a lot for that. Well, let's focus on some metal stocks, and you have the operational updates that are coming in there. Let's start off with Nalco, because that stock has done very, very well. It's very close to a 52-week high. And a couple of days ago, on Bazaar itself, we had cited that that's a stock to track. Now, they come out with the operational update. It looks very, very good, either which ways. They say that they've reported a record year. And at optimal levels is what they're functioning at. Whether you look at the aluminium business, 4.7 lakh tons is what they've delivered out there. On the alumina business, they have delivered close to around 2.1 million tons, which is, again, peak levels out there. And also the sweetener is that the coal block, that's the Utkal D coal block, well, they have operationalized it and they have hit peak levels of around 2 million tons per annum. And that's what's going to help them in saving costs. So good going on them. The only problem is the global Q is a little bit jittery and the stock is up close to 10% in this week itself. Next up is Moil. Yesterday, the stock was a little under the weather, but otherwise the operational performance looks good. They as well have delivered a record year in terms of production as well as sales numbers for FY24. Production is up by close to 35%, and that's much better than the previous best year that they have, fiscal year that is in FY 2008. So that's much better. The sales number as well is up by close to 30%. So 30% sales growth, 35% production growth, and EMD, which is a small part of their business, but that's an import substitute. On a small base, that as well jumped up by close to 28%. So good going out there. And finally, Hindustan Zinc. They have delivered their highest ever quarterly metal production. The zinc business, that's the one that led the way. That was up by close to 9% on a sequential basis and 2% up on a year-on-year basis. Even the lead business, on a sequential basis, that's up by close to 5%. And they're saying that the mined metal production has been driven by improved metal grades as well as higher ore production. The saleable steel, that's the saleable silver. That's a sweetener that comes in there. Silver prices have been strong, and now they're clocking 189 tons on a quarterly basis. For the year, they're close to 750 tons. So that one as well should see a positive opening. Keep in mind, only around 2.5% of the float is in the market. So that's something that you should track. But Sonia, you're tracking Bharat Forge and the likes.
Yes, I am, because the North American Class A truck order data is out and it's not looking good. So watching out for that one, both on a month-on-month as well as on a year-on-year basis. The truck data is indicating a fall. Now, remember this entire segment, right? Globally and locally, the commercial vehicle space has been under pressure. Growth has moderated. It's also coming off a very, very high base. So, just keep an eye out on that. The March North American orders have come in at 17,300 units. This compares to 25,700 last month. So it's a steep fall that we've seen month on month. And the orders have slipped month on month for the fourth straight month. Now, for Bharat Forge, this matters because about 11-12% of their business comes from the North American truck market. There are, of course, other companies like Ramakrishna Forgings, etc., that also get impacted due to this. So I'm going with red for these stocks because of the pressure that we're seeing in the North American truck market. But a couple of other stocks that are in the news this morning.
Yeah.
Okay, I think we
have Upasana. Let's get in
Upasana.
Upasana, if you could join in and give us some more stocks in the news.
Well, good morning. First up is Sunteck Realty. The company expanded its annual income business, annuity income business of its commercial portfolio, and it entered into a long-term agreement of its premium commercial building, that is Sunteck Econ, to Bennett Coleman. The build-up area of this is around 2 lakh square feet with a rental of almost 300 rupees per square feet per month on a carpet area basis, leading to a revenue of close to almost 2,000 crores over a tenure of 29 years. Hence, this stock will remain in focus today, and I expect to start in green. Next up is Anupam Rasayan. The company signs an LOI with Japanese multinational company worth rupees 743 crores over next 7 years. The contract is mainly to supply two advanced intermediates using fluorination chemistry. And lastly, Indiabulls Real Estate will also remain in focus as the board meeting is scheduled on 5th of April to consider the proposal of raising of funds by way of debt, equity or any other securities. Hence, these are the stocks that I'll be watching out today.
All right, thanks a lot for that. Well, let's do a quick recap of our top stocks with positive news flow. Ultratech Cement, Z Entertainment, Hindustan Zinc, Nalco, Moil, Sunteck Realty, Anupam Rasayan and Indiabulls Real Estate, while stocks with negative news flow, JSW Energy and Bharat Forge. But we've also had a spike up in crude, and that is something that's not gone down well with the street. Manisha Gupta is joining in for a roundup of all the action from the commodity markets overnight. Manisha, over to you.
Thank you for that, Sonia. Well, yes, the fears of broader conflict in the Middle East and especially Iran vowing retaliation against Israel is something that the markets have seen premium buying come in back in case of all of these tangible commodities. The crude oil prices surged yet again. They're trading at a 5-month highs right now. apart from the global concerns, the geopolitical concerns that is, it also is about the U.S. inventory seeing a decline for a third straight week. There are supply disruptions that we've been dealing in Russia with, and then Mexico also says that they will also cut their oil exports. The street will watch out for the OPEC and allies meeting today, while the major expectation is that they will keep production cuts at 2.2 million barrels per day till the end of June. But any statement coming in from the OPEC and allies is something that the street will watch out for. In the meanwhile, you have seen a run-up continue in case of metals as well. Gold is trading at yet another all-time highs. Silver is trading at a 23-month highs. Copper is trading around 11-month highs. Aluminum at a 3-month highs. So most of these tangible commodities, even as the dollar index is firm, seem to be doing quite well.
All right, Manisha, thanks very much for that. Well, that's commodities with gold and silver in focus. Actually, it's all commodities, right? Devin Chokshi is with us of DR Chokshi Finserv. We talk specific stocks when we come back in just a bit from now.
Welcome back. You're tuned into Bazaar Morning Call. Well, let's get you all the brokerages that have written overnight. Hormuz joins us to fill us in with some of those notes. Hi, Hormuz. Morning.
Morning, Nigel. I'll start off with a note on Asian Paints, and that's come from HSBC, where they have maintained their buy recommendation, but they have cut their price target to 3750 from 4020 rupees that they had a target of earlier. Now, what they're saying is that this is because of a possible imminent pricing disruption in the paint sector and the margin erosion prospects that are weighing on Asian Paints' stock price. And what they also say that the ambitious targets that Grasim has announced, remember turning profitable in 3 years, the 10,000 crore revenue mark, that is adding to the headwinds for Asian Paints. But what they also say is that the current pricing strategy that Asian Paints has appears sensible to them, and the fears that are surrounding the stock are likely to be overstated. But as a result of which they have maintained their buy recommendation but cut their price target. Next up is UBS, where they have assumed coverage on Chola investment, and that is with a neutral rating and a price target of 1290 rupees. And they say that Chola is better placed than its peers in a weak funding cycle, and that is because of the sector leading EPS CAGR of 26% over FY24 and 26, and there is a largely secured and long tenured loan book that they have, which keeps them better placed, and a continued diversification in its products as well. However, they remain neutral because the stock at its current valuation of around 4.2 times price to book is trading at a 24% premium to its long-term averages, as a result of which UBS is neutral with a price target of 1290. Back to you.
Okay, thanks a lot for that. Well, those are a whole host of brokerages talking about individual stocks and the way forward. Devin Chokshi, Managing Director at DR Chokshi Finserv, is joining in now to give us more details on what he expects with individual names. Devin, hi, good morning. I wanted to start with Ultratech Cement because there's definitely capacity expansion over there, but there's also lots happening in the cement space in general. How are you positioned here, and what should investors do?
Yeah, good morning, Sonia. Well, I think this space looks, absolutely very convincing, and I think ready to grow faster, largely because of few facts. On the demand side scenario, because of the higher amount of spending on infrastructure, on housing, and rest of the construction activities which are happening with the industry, I believe the demand side scenario is going to remain absolutely very, very strong. Whatever we have seen in last 2-3 years, these are what we are likely to see in next 2, 3, 4, 5 years. I think as far as the construction activity goes, I think we are likely to see a very big change as far as the amount of speed that we are going to be seeing in this particular space. So cement as a commodity, particularly in the building material segment, looks absolutely very, very well positioned. Though I agree that in some pockets, it is largely the regional play, but pan-India presence of players like Adani, Ambuja, for that matter, or for that matter, Ultratech, Grasim, they are the ones who are basically looking, really very, very strong from the point of view of seeing higher amount of play. With the price increasing and demand scenario growing at the same time, we believe that the situation turns very favorable for this commodity. This quarter in particular should remain absolutely very strong quarter, given the kind of projects completions that we are experiencing. So all in all put together, yes, I think it's an opportunity to add these stocks into the portfolio for around 20% odd kind of a return in the stocks.
All right. Well, just stay on, Devin. We'll come back to you. There's a stock that we're looking at, which is okay. We'll get to Thomas Cook in a bit. But before that, Devin, a couple of more stocks that I wanted from your end. One of them is JSW Energy. Any thoughts there? The company is going to be raising 5,000 crores through the QIP route. How are you positioned here?
So honestly, per se, I think we are not looking into this company, Sonia, but we believe in general, I think this entire space looks the well-positioned space. And the money which will come into this particular sector is likely going to be coming in from some of the large sovereign funds, among others. So in our view, I guess I think the likes of the Tata Powers, or for that matter, Adani Power, for that matter, even JSW Energy, the companies which are in generation and utility segment are likely to see higher amount of inflow of money. Also because of the fact that the capacity expansions, I think, is happening at a very high speed. And this is likely to continue. Maybe some amount of inorganic growth possibility can't be ruled out in some pockets. So that's where probably I think one could look at it. But in particular for this company, we have no view at this point.
Okay, all right. Hi, Devin. Good morning and good to see you, Vin. MOIL as well as NALCO, both of them have come out with their operational update, the production numbers for the past fiscal. And on expected lines, because they've been talking about it all through the year, that they're quite good. But both the stocks have run up considerably. Maybe valuations, particularly for NALCO, may not be supportable. But you have momentum with these stocks. So what's your view on both of them?
Yeah, Nigel, good morning. Well, I think the momentum is expected to continue as well, because amount of money which is getting into these stocks, I think, is on the higher side. Look at even the Coal India kind of a company from the production numbers that they are announcing. At the same time, I think the other mining stocks as well, I think, where you are probably seeing the higher amount of production taking place. On one side, the demand scenario, their customer segments are growing, and on the other side, I think up till now, these companies have been struggling with the production. Now, at least we are seeing the consistently maintained production as far as I think these companies are concerned. We believe that I think the opportunity is right, but as you rightly pointed out, in some cases, the valuations have already factored this particular possibility of higher growth numbers. So to a certain extent, we might see price correction, at the same time some amount of time correction in this stocks. That is the opportunity that one can possibly look around for to get this stock into the portfolio. As of now, no specific view except I think the NALCO, where we believe that the company is looking relatively more stable from the business point of view.
Lots of big movers yesterday, right? I mean, there was the Aditya Birla Group stocks, ABFRL, AB Capital. Devin, hi, morning. Anything? Any thoughts? Do you like any of them? And second, Indiabulls Real Estate, rallied sharply in the last 1 hour. I think ended about 8% higher. Then after market hours, there was a notice that on the 5th of April, there is a board meeting where they decide on fundraising. Nimesh had sort of hinted at some sort of action coming through over the last couple of days. But your thoughts if you track any one of the three?
So, Aditya Birla Fashion, Prashant, good morning. Aditya Birla Fashion, particularly, I believe that I think it looks relatively interesting to me per se. See, they're carving out a separate brand portfolio of 20 brands into this Madura Fashions, and they are creating, I think, a separate company. What it indicates, one or two things to me. One, I guess, I think they probably require larger amount of funds to grow this particular portfolio. And on the other side, I think if you look at what Reliance Retail strategy is, they are probably accumulating the brands in the portfolio systematically, either inorganic way of acquiring the brands, or at the same time, I think creating the domestic brands, in-store brand as well as online brands. They are creating separately into their portfolios. And at some point of time, the monetization has to take place for sure. But the one with a larger amount of portfolio would probably get the better advantage, in my understanding, going forward when they monetize these brands. So Reliance Retail could be, I think, relatively more interesting proposition compared to the Madura Fashion, on which I think Adi Villa group is probably demerging this company. Wait and see, of course, because I think this is for the first time which is happening that we are experiencing a smaller brand portfolio company getting demerged and probably I think trying to put more money into it. As such, we know that I think this business, I think margins are going to be thin unless I think you have got sufficient number of capital to back you up. I guess I think the profitability is not going to be there. That is where I think it will be an interesting play to watch out for. As of now, we don't have much view on this particular subject as far as Aditya Birla Group is concerned. But we do believe that I think the strategy of Reliance Retail is probably playing out well at this point of time.
Okay, all right. Devin, I request you to stay with us. We'll talk about the travel and tourism space as well in just a bit. But for the time being, let's turn our attention to Thomas Cook. Remember, we've had a couple of long weekends and we have a couple of more in store as well. Well, to find out about how business is doing on ground, we're joined by Mr. Menon, the Chairman and Managing Director at Thomas Cook. Hi, Mr. Menon. Good morning and thanks so much for joining in here on CNBC TV18. Well, tell us, how is business shaping up? And also, in particular, tell us how is long haul in comparison to what it was pre-COVID. I recall the last time we chatted, you were optimistic that it will come back to pre-COVID levels. Is it moving in that direction?
Good morning, Nigel. Thank you for having me on the show. Yes, we're seeing continued demand, Nigel. We're witnessing demand across all our segments. Obviously, in recovery terms, the strongest recovery has come in both domestic and short haul. When I talk about short haul, I'm talking about Central Asia, the Middle East, and Southeast Asia. In terms of the long haul, yes, there has been a recovery. We're not completely there in terms of 2019 numbers, but my suspicion is that we will inch closer over the summer. You will appreciate that the travel periods have just widened post-COVID. So my expectation is that we will continue to see strong growth in our forwards.
Mr. Menon, good morning. Absolutely. I mean, travel has come back with a vengeance, right? One would have thought that last year was a good year, but looks like this one's going to be even better. But can you tell us a little bit about the breakup in terms of the revenue mix? How much of your incremental travel or your revenues are coming in from, your B2B segment, which is your corporate travel, MICE, and in the B2C long haul and short haul? If you can just break it up for us, where are you seeing maximum amount of demand and what could the growth look like?
Good morning, Sonia. First of all, I presume you're taking more holidays than you did pre-COVID. No, look, I think...
No, I think all of us perhaps are because, during COVID, of course, there was nothing. Post that, everything has come back with a bang, but I've also seen the prices go up significantly, right? So that seems to be a bit of a hindrance.
Look, I think supply-demand disruptions continue, and they're due to a variety of factors. In terms of the breakup of revenue between our B2C and our B2B businesses, you'll appreciate that we've seen double-digit growth on our corporate travel side, and corporates are traveling as they did in the previous years. There's been no change in that. In terms of MICE, the first quarter is invariably the last quarter of the financial year is a little slower, but I must mention here that despite that, we are seeing growth in terms of demand over a year ago. In terms of leisure travel, I think that's really been the growth factor in this last quarter. And my expectation is that we will see that the leisure travel continuing through the rest of the year, as would corporate travel, and MICE picking up speed as we get into the first quarter of the next fiscal.
So can you just quantify that for us? What could the overall growth be for the full year? And how much will come in from leisure travel? How much would, if you can just give us the numbers, how much from corporate travel?
Sonia, we're in a silent period. I would restrict myself to saying there's been double-digit growth across all our travel segments.
Okay, all right. Mr. Menon, hi, morning. You said you will probably get to those 2019 numbers. Not there yet, but of course, I mean, you're on track for that. So just pulling back a little bit are we looking at that this year, FY25? I mean, you're getting back to those numbers?
Yes, we are. Prashant, I think, visas are not a total logjam as they were a year ago or maybe 2 years ago. The reality is that it has eased from there. Some of the regulations have changed. The US still continues to be a challenge in terms of visas. However, what we're witnessing is people who have visas coming forward and traveling into the US. In fact, we've seen some amount of deviation in terms of the long haul. For example, as we talk, we're seeing record travel into Japan to witness the cherry blossom, something that we had witnessed earlier, but the sort of demand we've seen this year is significantly higher than a year ago. As far as recovery of the long haul in fiscal 25, yes, I expect a full recovery. I have no doubt in my mind that at this current trend of easing of visas will continue. Going back to Sonia's point of higher input costs, I think that remains an issue. But having said that, people are willing to pay the higher costs as they want to travel, and it no longer seems to be as big an issue as it was maybe 12 to 15 months ago.
Okay, no, that's very good to hear. Just, Mr. Menon, on the sterling business, could you tell us, what's the opportunity that you're looking at? And if you can just, I can tell you that we've got 2 sterling memberships in the family for the last 20 years, actually. So not recently, but what's the potential as you see it for that business?
So I think we're going through an expansion mode on the hospitality side, Prashant. What we're doing is we are adding new hotels literally every quarter. And for example, in the last quarter, I think they've added 3 hotels. We'll continue adding on an average a hotel every 1 to 1.5 months going forward. Despite the expansion that we've witnessed over the last 12 months, we are actually seeing our occupancy rates remain steady. Average room rates have gone up. So I think sterling offers an excellent opportunity going forward. And this is in line with the hospitality demand that we're witnessing across the entire sector. So yes, I see demand growing. It hasn't slowed in any way. We've spread our network across India. And my expectation is that we will be at about 55 hotels by the end of the third quarter this year.
Yeah, I recall when we chatted last, you said that you're expecting occupancies to stay in that mid-60s, and also you were looking at adding rooms, and average room rent should go up to around 7,000 rupees. Final question, Mr. Menon, before we let you go. For FY25, top line growth of around 20%, stable margins, and ROC moving to around 15%. Is that the goal?
So, Nigel, on your last point, I got a lot of flack the last time. So let me address the first 2 points. Yes, we're going to see double-digit growth. We are controlling our costs as tightly as we can. And this has been helped by the fact that we've introduced technology, as I mentioned to you the last time. And we're seeing greater demand emerging across all our businesses. So I'm looking forward to a fiscal 24-25 to represent good growth, both on the top line as well as on the bottom line. I will qualify that the bottom line will not grow as dramatically as it did last year when we were in recovery mode. As we're coming back, obviously those will stabilize.
Okay, all the best for the future, Mr. Menon. Thanks a lot for joining in. And this is a space that is booming right now. So hopefully you'll get to ride this wave further. That's Thomas Cook with the way forward for the business. But let's get back to the markets now. In all likelihood, it will, of course, be a gap down opening. But what happens from there? Will the dips get bought? Anuj joins in for a quick trade setup. Hi, Anuj. Morning.
Morning, Sonia. You know what? It's a test of the market's texture, right? Normally, in a big uptrend, the first gap down is bought. That's a leap of faith trade that traders take, especially if the gap down is due to the global factors and not domestic. So let's see, the first dip could get bought, but on days like today, there's also a second dip because the global mood is bad. So that second dip is more important. In the second dip, if the morning low is broken, the market normally falls. But if the second dip is also bought, in that case, there's a big rally in the last hour or so. So let's see. I think a big day of trade is coming up here because the market's texture has been strongly buy on dips. Mid-caps might recover first. In fact, I won't be surprised to see mid-cap index in green at some point during the day today, because it's really been very strong and we've started to see a big positive advance declines. So if you want to focus on individual stocks, perhaps that could be another strategy. Now, talking about the levels on the Nifty, the first support is 22,300 to 22,350 based on the options data and also the 5-day exponential moving average. And the bigger support is 22,166 to 22,240, the 10 and 20-day exponential moving average. After the gap down, the first resistance would be at the even Steven mark, 22,453. And then 22,500 to 22,530, the all-time high zone. I think the Bank Nifty, where you have the weekly options expiry today, could give you one decent swing. The first support here is 47,385 to 47,400, thereabout, options base, and yesterday's low. And the bigger support is 47,100 to 47,220, 5 and 10-day exponential moving average. The resistance comes in at 47,550, yesterday's close, and bigger resistance is 47,707. As always, I'll leave you with quote of the day. And today, you know, is the birthday of Marlon Brando, the godfather of modern day acting. And a very interesting quote, I think to regret is useless in life. It belongs to the past, something which we should all implement in life.
Well, that's one of the all-time greats. Actually, the GOAT, according to me, as far as the last, 2 generations ago in acting. Anuj, thanks very much for that. Something to light up our moods, as always.
I thought you were calling Anuj the all-time great, so I was like, slightly confused. Well, 2 all-time greats then, right?
But we have the picture right next to it.
But living life with no regrets, I think that is something that all of us.
That's the only way to live it.
Yeah.
that is also the my all-time favorite song as well from Devanand, right? मैं जिंदगी का साथ निभाता चला गया, हर फिक्र को धुएं में उड़ाता चला गया.
All right, well, we'll take a quick commercial break. We'll come back and we'll have our technical experts join in with some set up some trading ideas, actually. Mitesh and Sudarshan will be with us to do that in just a bit from now. Stay with us. All right, Mitesh and Sudarshan are with us with what they'd want you to do as far as trading ideas are concerned. Thanks very much, both of you. Mitesh, it's going to be another down day, another look through a kind of a day, or you think it's perhaps going to cause some lasting damage beyond a day? What's your sense?
Good morning, Prashant. I think, I would still not be worried about the markets getting into a damaging or a negative mode. I think the overall structure is quite good. But I've been maintaining that till we get past 22,530, which is where we have had an intraday high around the 7th of March, and then yesterday, which is the day before yesterday, which is Monday. I think till we cross the earlier highs, I think there is a chance of profit booking happening always, and that remains. Now the worry will come in case we start seeing the Nifty to break below levels of 22,250. I think till that happens, I would want to buy on a decline, which offers me an entry closer to about 22,300. And keep a stop below 22,250. Only if 22,250 is taken out, then I think I'll look at getting into some kind of a negative move.
Okay, Sudarshan Sukhani is also with us. Sudarshan, hi, good morning. This has largely been a buy on dips market. Do you advise investors, traders to buy this dip when it comes through today?
Good morning. Well, it is a buy on dips market, and we should be looking at a dip to buy, but today is not the day. There is a sense I'm getting that maybe we'll enter into some kind of a consolidation or even a small correction, because we've tried to hit that cross that 22,550 new highs level twice and not really succeeded. So wait, be patient. Today, I would not advise buying. This dip can become deeper on the downside in the next few days. So wait for a reasonably lower level, maybe 22,200, 22,100, wherever this decline stops, if it comes about. And if it doesn't fall, it'll consolidate. So either ways, you'll get sharper dips to go long into. Today is best not to do anything.
Okay, all right. Best not to do anything. That's what Sudarshan's call is. Sudarshan, what about stock-specific action, though? What are you looking at?
Well, it's a mix. Bharat Petroleum is a buying opportunity. Stop under 566. Shree Cement is an intraday short. The stock was in a downtrend. A small rally is likely to fizzle out today. Sell above 26,723. Bharat Forge is similar to Shree Cement. Small rally after a big decline. That's probably a bear market rally. Sell into that. with a stop above 11,160. And finally, Gujarat number GNFC is a buying opportunity with a stop under 613.
Okay, Mitesh, what about you?
I have, in fact, more of buy calls today, with the fact that my view remains positive. The only thing is that entry has to be slightly tactical. So BEL can be bought on decline around the levels of 218, 217 with a stop at 213. Look for targets of 230 here. AB Capital similarly is a buy on mild decline. Let's say if you get it around 198 half, 198 levels, then keep a stop below 193 half. Look for targets of 210 to begin with. And Balrampur Chini, if it can clear yesterday's high of 384 half, 385, then buy with a stop at 377 for targets of 400. And one sell call, that's Bharti Airtel. Keep a stop about 1221 for 1180, 1175 as the target.
Mitesh, two more names. One is technically Indiabulls Real Estate. How is that looking? Saw a sharp move. There is some fundamental news flow expected. They're raising funds. There's a board meeting on the 5th. That's Friday. That is one. 8% jump in the last hour. And then Shilpa Medicare, which also has been rallying. It's crossed the 500 rupee mark. Technically, how are these two looking?
One is Shilpa Medicare, right? The other stock, if you can repeat it again.
Indiabulls Real Estate.
Sorry. Yeah. So Shilpa Medicare, I think, is in a medium to long-term uptrend. If you see, the rally started from about levels of sub 350 and has nicely moved up to about 500 plus levels here. I think the first target on the medium-term chart is closer to 540, but a realistic target is closer to about 600. So I think there's still about 20% kind of an upside left. I would suggest a hold over here. Indiabulls Real Estate could be very interesting. It made a couple of highs around this 123, 124 mark, which was way back in February, and then again in the end of February, and then again on the 4th of March, and now it's breaking above that. So if yesterday's high is being taken out, I think I would be giving a buy here with a stop below 120, and a target of 155, 160 could easily happen.
Okay, all right. We'll come back to you guys in a bit. But before we slip into a break, here's something that you must not miss out on. CNBC-TV18 presents India Exchange, where market experts and industry stalwarts will collaborate in insightful discussions on India's economic path and the evolving dynamics of the Indian market. Mapping the macros with City India economist Samiran Chakraborty. Catch a jugalbandi between market veterans Manish Chokhani, Ramdev Agarwal. Return of the animal spirits within India Inc. A conversation with V. Vaidyanathan of IDFC First Bank, Keki Mistry and Manish Kejriwal of Kedara Capital. And chasing alpha with market experts like Nilesh Shah of Kotak, Prashant Khemka of White Oak Capital and Anish Tawakle of ICICI Pru MF. Don't miss out on this. Tune in to CNBC TV18 on April 4th, 5:30 p.m. onwards. Welcome back. This is Open Exchange. You're watching us live from the CNBC TV18 Motilal Oswal studio. Well, we have Rajesh Palvia, Vice President Technical and Derivative Research at Axis Securities, joining us now. Rajesh, hi, good morning. How are you feeling about the market? It's been a bit volatile all over the place. But do you think this uptrend is something that's intact, and what are the stocks to look at?
Good morning, Sonia. So this is second consecutive day where, Nifty is forming a dozy kind of candlestick formation that clearly shows that, there is an indecisiveness at the current juncture for the Nifty. But looking at the broader picture of market, we believe that, the kind of buying action which we have witnessed in last couple of trading session on the broader market, that clearly shows that once we able to take out 22,500, 550 zone, then this rally can extend further and possibly we can see target towards 22,700 to 800 also for the Nifty. So buy on dips should be the strategy. Looking at the call put concentration, the major put base is now placed at around 22,300. So if we get any kind of dip towards 22,350 on Nifty spot, it's a buying opportunity again to play this up move of market. We are initiating here to buy 22,350 call option, which was closed at around 149. So in this gap down opening, you will be able to get this call option around 120, 115 kind of zone. So you can buy around those level with stop loss of 85 rupees. And on the again, we are expecting that, pullback may be there into this session. And again, Nifty can move higher to 22,450, 22,500. So this call option can give you a target around 175 to 180 kind of zone on the higher side where you can book profits. On the Bank Nifty is still struggling to cross its major supply zone or call concentration area of 48,000. That needs to be watched closely. If at all we crosses those levels, then short covering action could trigger, and possible upside target we can see towards 48,500. That's the target we can see for Bank Nifty. But till the time Bank Nifty not crosses those level, at this moment 47,200 is the important support area on Bank Nifty spot. So again, buy on dips is again a strategy for Bank Nifty also. At this moment, the stocks which we like at current juncture, that is one is from hotel industry, that is Indian Hotel. Stock is almost trading near to its all-time high trajectory. Long built-up was there in previous session, and we believe that continuity of this uptrend is likely to be there in Indian Hotel. So one can buy Indian Hotel for upside target of 625 to 630. Keep your stop loss at around 598. The second stock that we like is from banking space, that is IDFC First Bank. Stock managed to give breakout of its falling trend line on daily chart, and looking at the reversal on daily chart, we believe that this momentum can extend further. 84 to 86 could be the possible target in near term. Keep your stop loss at 77.50. And the third stock is Bharat Electronic. Again, the stock managed to give breakout of its previous swing high of March series, and looking at overall structure, we expect Bharat Electronics can continue furthermore upside towards 235 to 240. So one can buy this stock with stop loss of 215.
Okay, all right. Thanks a lot for that, Rajesh. Wishing you a good day ahead. Well, let's hop across to Vamakshi. She's here to tell us about today's Momentumizer stock of the day. Vamakshi.
Well, absolutely, Nigel. I'm focusing on Samhi Hotels. Keep in mind that from the beginning of the year till Feb end this year, the stock had managed to surge by almost 41%. But since then, the stock has declined by almost 14%. In fact, yesterday as well, the stock was down around 2%. The total value traded, however, yesterday, that is important to note, was almost at 635 crores, which is the highest that we've seen for this counter since its listing on September 22nd. 2023. The volumes were at almost 7.5 times the 10-day average. Now, the fall yesterday was on the back of some block deals. Goldman Sachs Investment Holdings Asia offloaded its entire 7.84% stake worth almost 342 crores. Goldman Sachs Singapore PTE ODI bought almost 73 lakh shares, which is a nearly 3.33% stake at 200.18 per share. Now, keep in mind that this was marked as ODI, indicating that the shares were bought on behalf of other entities who do not have an FPI license in India. Another buyer was Aditya Birla Sun Life Mutual Fund. They bought 15 lakh shares, which is a 0.7% stake at 202.54 per share.
Okay, all right. Thanks a lot for that, Vamakshi. Well, let's focus on the cement space, and we'll get to an analyst in just a bit. Rajesh Ravi is waiting by. But let's give you a quick backdrop. Now, yesterday, some unconfirmed reports suggested that there was a big price hike that was taken in various parts of the country. And the range that was given was around 20 to around 80 rupees per bag in various parts. South, it was supposed to see the highest price increase. And in Maharashtra, maybe 20 to around 40 rupees. That's what unconfirmed reports did suggest. Now, I think it's a little bit too early to celebrate. And I'll tell you why. Because you need to see how much of this price increase is actually accepted by the customer. Point number one. Point number two is, towards the end of the last fiscal, you'll see, like any fiscal, you see a lot of volume push. And this time around, it was a little bit more severe. So some of that inventory is still lying in the system. So only once that gets cleared out, then you'll get a better sense in terms of how demand is shaping up. And also ahead of an election, price increases, it'll be very interesting to see how much of that is accepted. So the price increase could come about, but it could be a little bit too early to celebrate that this entire price increase has been accepted. But there's good reason for a price increase. And that's because in the past quarter, you look at any geography, well, there was a sharp decline in pricing. That's in quarter 4 if you compare it to quarter 3. Particularly in South India as well as East India, you saw prices that were down severely. And pan-India prices were down by close to around 5%. That's quarter 4 in comparison to quarter 3. So pricing was weak. That gives good enough reason to see some bit of a rebound in the month of April itself. Now, in March itself, prices, they were down by close to around 2.5% because of the volume push. And prices visited the lowest level we've seen in nearly around 3 years. The positive, though, was that volume growth could be a little bit better in quarter 4 in comparison to what the street was working with. Brokerages, both Jefferies as well as Incred, in their notes, they said that yes, they're expecting a price increase in the month of April. So a price increase will come about. How much of it is accepted is very, very important. And for the time being, it could be a little bit too early to celebrate these large price increases. So the better trend will emerge in the next 1 week or so. To help us out with a quick analysis on the cement piece of news, we have Rajesh Ravi, institutional research analyst, cement at HDFC Securities, who joins in. Hi, Rajesh. Good morning, and thanks so much for joining in. Well, have you heard anything with regard to a price increase so far? And how much of it do you expect it to be accepted? The problem is that the price increase could be pushed through. The acceptance could be far lower, as we have seen in the past.
Hi, good morning, Nigel. As far as the price increases, this is an usual phenomena. The industry has passed by through a stormy quarter, Q4. Start of the Q4, I'll just give a context. The start of Q4, the general expectations were that the industry realizations could improve a bit. As against that, we are, Q4, we are staring close to 5% price decline quarter on quarter, which is quite sharp, given this was the peak quarter. And obviously, at the end of Q4, the industry will look forward to take price hikes, and hence these announcements will keep on happening. As you rightly said, Q4 March end was also the year end, and hence there's a lot of inventory push, which has already happened in the channel. And in any month, quarter end, there is already a good amount of inventory with the dealers. So any price hike announcement, they're more just on papers rather than getting absorbed. And any absorption, if at all, will only be effective from after, say, end of first week or 10th of the month. So we'd have to wait and watch. So South and East market have seen significant erosion in realizations sequentially, and hence the effort will always be there in these markets to make meant for better through better price hikes. So these price hikes, in my sense, whatever announcements, the industry will need price hikes for sure. But the effectiveness of the current price hike will depend on how demand shapes up post 10th of April.
Absolutely. A very, very good point. Rajesh, we made this point even on closing bell yesterday, that there could be an attempt to push through the price increase, but a better trend will only emerge after the 10th of the month, because that's when you get a sense of demand as well as inventories. Yes. But you'll be factoring in some price increases, right? So for quarter one, what kind of a price increase would you be satisfied with? And given that it's an election year, maybe you want to give us for the year, what kind of a price increase are you factoring in for the industry?
Right. So see, FY24, we were earlier expecting that the realization would be higher by 1%. As against that, given that the Q4, dent which has happened, full year realizations are down maybe around 1%. Now, as against that, when we look into FY25, the first half for sure, everyone is cautious. Non-trade demand will be low, and hence the volume, whatever sales and pricing, they need to focus on the trade segment. And in trade, price absorption is relatively better. So in FY25, while volume growth will suffer as against 7 to 8 to 9%, which is a growth number for FY24. FY25 numbers, demand numbers could be slightly slower. And in this context, my view is that the industry will see a better pricing, close to 1 to 2%. And that is because of the trade channel, higher sales in the trade channel where price management is relatively better. You have a brand distribution and the premiumizations which help you. Non-trade, it's quite difficult to take a price hike. So in FY25, be it April or April, industry will try to take some price hike. And we'll also try to not let the prices drift lower if on the worst case during the monsoon quarter. So that will keep the, and later on take further price hikes. So we are expecting that in April, there could be 2 to 3% price hike, which could get affected. But it is also to be supported with on the trade side, demand on the trade segment.
Sure. I wanted to understand a little more about demand trends itself. What are you seeing since we're heading into election season 2? Where are you seeing maximum amount of demand? Is it in infrastructure, in real estate, from the government side, from the private side, geographically as well? If you can just give us some trends.
So, if I look at the Q4 trend, what we are understanding, there has been good sales in the non-trade segment. And that is why the focus on prices have been low and prices have taken a dip. And as I said, starting Q1 and Q2, being elections quarter and government formation and all, demand from the infrastructure segment should be relatively muted, and the industry will focus on the trade segment. And in my understanding, the trade segment is doing relatively decent. There's not much of a negative news flows on the demand in the trade segment. So individual housing and real estate segment continues to do good. So overall demand should be driven from the non-infra segments.
Okay, demand from the non-infra segments. Coming to individual stocks then, I mean, everyone, of course, is talking about the expansion that Ultratech Cement is doing. So wanted your thoughts on foreign investor, retail investor. Is there a lot more potential here? And what are the top picks in this segment now?
So in terms of stocks, we are suggesting among the bigger names, we are positive on Ultratech, and we believe their capex program is going as per plans. The stock, even at current valuations, while near term the sector could see a consolidation because of the uncertainties on demand and price volatility. However, we still believe Ultratech is a good story steady good story. Below that, we believe Dalmia offers good returns even at current level. The company has near-term triggers in terms of the volume growth, which was poor related to the markets in the first 9 months, for that to pick up in Q4, and also the first phase of JPA assets acquisition, which seems likely maybe going through in this quarter. If that happens, that could pep up the valuations for Dalmia Bharat. And among the mid-cap names, we are positive on JK Lakshmi, where we believe the volume growth visibility has improved with the commissioning of the Udaipur capacities, and even Birla Corp has good volume growth visibility near term. So these are the stocks we are looking at as good opportunities.
All right, Rajesh, thanks very much for joining us. It's a pleasure having you with us here on CNBC TV18. There's about 3 minutes to go for the market opening, and the pre-open rates, of course, have been putting out. Mitesh is here with his 9-10 call. Mitesh, what do you have?
Well, you go with the buy on AB Capital for targets of 210.
All right. AB Capital, right? So that's the call from Mitesh. That's a 9-10 call. Nimish is here with the standout brokerage report that he wants to highlight. Nimish, morning.
Hi, morning, Prashant sir. Today's standout is on Divi's Labs. Technically a double upgrade. So BofA Securities has today upgraded the stock to buy from underperform, and they've sharply raised the target price to 4025 from the earlier target price of 3380. Now they believe that the consensus downgrade cycle is likely to end in the near term with strong visibility of growth going forward. In fact, they expect 35% EPS CAGR in FY25, FY26 on the back of new generic API launch, contract media scale up, as well as Kakinada commissioning. So big earnings growth is what BofA is expecting. They believe that the risk reward is favorable, and valuations at 35 times on FY26 price to earning is much more compelling than the large peers. They're highlighting few risks as well, which includes worsening of generic API pricing going forward, a delay in the ramp up, as well as a slowdown in the custom excentrics. But a double upgrade on Divi's Labs from BofA Securities and a sharp target price increase to 4025 now.
Okay, that's interesting. BofA Securities double upgrade from buy, from an underperform to a buy. Okay, well, thanks a lot for that. For the market, I think, it's of course going to start in the red. That's because global cues have been weak, and there has been some selling pressure from FIs as well. But I think the market has been so domestic driven. If you look at it, last 10 days, DI have been pumping money left, right and center. I'm not sure whether this is a pre-election rally or not, but at least the market has recovered substantially from the lows that we saw in the end of March.
Absolutely. And, maybe a little lower, right? I mean, you get to about 22,300 or so, it becomes a more attractive kind of a level that you'd want to buy. And those are 22,300 is where the hourly averages come in as well. But first rates, right? The Nifty starting at about 22,376. So that's the first tick in line with what the pre-open indicated, about 60, 70 points lower. And there you go, 77, 79 points lower. The sensex is down 260 points, 73,646. Bank Nifty starts about 1/3% lower. We are 150 points down. Yesterday, of course, the Nifty Bank consolidated for most of the session, 47,400. You got the mid-cap index, which is starting about 1/3 lower as well. Mid-caps and small caps last 2 days, sharp outperformance compared to large caps is what we have seen. But, well, these are indices. Sonia's got rates as far as stocks are concerned. Sonia.
Well, thanks a lot for that. I'm going to take it straight to stocks. So let's take the ones that are in the news first up, right? You have JSW Energy that will be raising about 5,000 crores through the QIP route. The street likes that, and hence the stock is outperforming the market as we speak. Ultratech Cement, we've talked about that ad nauseum. There's a capacity expansion plan. There are 2 new greenfield units that have been commissioned. Ultratech Cement is one of the big gainers this morning, up almost 2% in a market that is falling. Zee Entertainment has come out with some cost rationalization measures, and the street likes that. The MD and CEO Puneet Goenka has taken a 20% pay cut, and that's something that the stock is reacting to as well. MOIL, it's been a record year of production and sales for them in FY24. Look at the move there in MOIL, 5.5% higher. Volumes are also picking up there. Now, Asian Paints is something that has, perplexed a lot of investors because of its underperformance. And this morning, HSBC has cut their target price to 37.50 from 4,020, which is still well above the current market price. But there are a lot of people who are now waking up to the fact that there is severe competition in the system. HSBC talks about imminent pricing disruption in the paint sector, prospects of margin erosion as well. So Asian Paints is reacting to that, now down about 1%. Let's move to some of the IT names, because this is a very interesting space. Now, CLSA has gone ahead and upgraded 3 IT stocks. They've upgraded Tech Mahindra to a buy from an outperform. They've upgraded TCS and HCL Tech to an underperform from a sell. And they talk about how players like TCS are big beneficiaries of the recovery that we're seeing in demand, especially from some of their orders like BSNL, etc. So these are the couple of stocks that they like. So these are stocks that are in the news this morning. Otherwise, for the market, Prashant and Nigel, it's not so bad. I mean, yes, it is down about 90 odd points. But after the initial gap down, we're sort of holding on to the 22,300 level. Would be interesting to see how the rest of the day plays out. Do the dips get bought? Time will tell.
Well, that's right, Sonia. Thanks a lot for that. Well, just keep an eye on a few stocks. Bharat Forge actually is down close to around 2.5% odd. The March North America order slip for the 4th straight month. They're down to close to 33% on a month-on-month basis. So that's one of the big losers, actually. You have Ashok Leyland as well that's pulled back close to around 2%. Godrej Consumers down close to around 2% in trade today. What's doing well? Well, Nalco is up and about, post that operational update. So that stock is doing quite well. Vedanta has valuation support as well. We had highlighted this at around 250, 260 rupees. That if Mr. Anil Agarwal can get his house in order, well, valuations will support them. And with the global trends, well, that's what could support them as well. So that stock is up close to around 1.5%. From the broader markets, a few more notable movers. Jai Prakash Power, well, that stock is up close to 4%. It's one of the top volume traded stocks. GMR Power as well is up close to around 3% as we speak. One of the top volume buzzers out there as well. On the losing end, Suzlon is down close to 100%. The stock had bounced up from around 36 rupees to around 42 rupees. But today, it's coming for some profit taking. Prashant.
Well, you've got a few more names, right, which perhaps deserve a mention. And I'll start with what's up. Market breadth, by the way, it's too early, but 1,100 higher and about 920 lower. So it's pretty close. On the upside, Cochin Shipyard is up 3.5%. It's got large volumes. Commodity strength has been something we've been pointing out. I spotted ONGC, which was slightly higher. It's a down market, so green stands out. MOIL is another one, which is up 5.5%. MOIL, by the way, has been an outperformer for the last 4-5 days now. Gensol is up 4.5%. I think they have reported numbers just a while back, 945. We've got Sadbhav Engineering, which is up about 5%. Volumes, I think, are very low. At least they're not picking up very, rapid fashion right at the outside. Irida is up about 3.5% as well. So these are the top volume-led gainers. As you can see, it's a fairly short list right now. On the downside, apart from what Nigel has already mentioned, Ramco Cements is down about 1.5%. And AU Bank is down about 1.25%. Lodha, I think got mentioned earlier, 3% lower on Lodha, and it's got decent-sized volumes as well. DLF is down about 1% as well to start the day with. It's a lower start as expected, but we've got a full session in front of us.
Just want to correct myself on Ashok Leyland. It's gone ex-dividend, actually. So that explains why the stock is down close to around 1.5% odd. 4.95 rupees. So that's effectively, X of that, actually, the stock is higher. So that's the reason why, in fact, that stock is lower. And also the cement stocks, as we pointed out, in late trade yesterday, the street was bidding up these stocks
they
in
had a rally.
anticipation of the price increase. Now they're coming to terms that maybe there'll be a price push, but we'll need to see how much of that is accepted. So that's going to be important to track for the next week or so.
I just want to mention one thing. Divi's Labs that, Nimesh was talking about, the double upgrade that has come in. Divi's Labs is now up almost about 1% and you also have the entire IT pack which is seeing buying interest. So Tech Mahindra is one of your top gainers after CLSA is upgraded. Would be interesting to see if, these IT stocks come back in a big way considering the fall that these stocks have seen.
Absolutely. Well, we'll find out. Sunil Kaul is with us now. Let's put some questions to him about the markets. APAC equity strategist with Goldman Sachs. Sunil, great to have you with us here. Thank you very much for your time. So just wanted to get a first sense about you about what foreigners are doing, because you'd have interactions with large global funds, emerging market funds, etc. At the margin, one has been, and it's now found its way into mainstream press. There was an article yesterday saying that many emerging market investors are starting to unwind the long India, sell China trade, tactical, etc. But it quoted some very large fund managers with large AUMs. Is that something you're noticing? I must say, the reason, of course, which was cited by most of them was valuations, the big valuation differential, and also kind of pointed out that it's largely tactical. But is that happening, Sunil?
First of all, Prashant, pleasure to be back. Look, some of it is happening. As you said, the primary concern around India in terms of clients has been around valuations. Although I would say our core view is still positive on India. We still think that the fact that fundamentals are strong, earnings are coming through, that should offset some of the concerns around valuation. So we still like the market. On your question about India versus China, the market, if you look at the Chinese equity market, the market actually has rallied around 15% or so from the bottom, right? So the China rally is already kind of taking place. And on the margin, we actually have seen some investors kind of getting into that. But as you said, I think a lot of the investors we speak to who have sort of got into the China trade are largely either hedge funds or quant managers, not a lot of the long onlys in there. So I would say that also explains that on the margin, people are kind of viewing it as a tactical trade, and there are some people doing it. But our sense is that if you look at the broader pool of money, including some of the global funds, which are much more bigger than the Asian and the emerging market money, they're still sort of underweight India. And because of the stronger fundamental story, you can still see allocations improving in India over the next course of next 12 months.
Okay, allocations could improve in India over the course of the next 12 months. By the way, it's not a bad market at all. Just look at that. The Nifty is barely down about 0.3%. The mid-cap index actually is down just 0.2%. So given the kind of global volatility, this is a very, very resilient market that we have on our hand. Sunil, hi, good morning. I want to talk a little more about the broader, perspective on the market. But before that, we were just mentioning how CLSA has sort of upgraded the IT space now. And I noticed in your own report that you have also raised your stance on the IT sector to neutral. I want to understand, is that because valuations are looking attractive now? Or do you think the worst of, cut down in client spends, lower demand, etc., is out of the way? What's your rationale there?
Yeah, Sonia, I think that's a great question. I think it's the latter. So we do think that numbers bottomed out in the December quarter. So I think the March quarter numbers in the 1Q reporting season, which will just start, I think the numbers may still be a tad softer, obviously given the guidance from Accenture as well. But we think March will be better than December already. And going into the second half of the year, we think numbers will start to improve much more materially. Bear in mind, as I have spoken before, we also have a much more constructive on the US economy as a whole. So we don't obviously have a recession as our forecast, and seems like market is coming to that view as well. So overall, our sense is that, IT is a sector which has obviously underperformed quite a bit if you look at the last 2 years in general, and the numbers have been cut as a lot. And so our sense is that things have sort of bottomed out here, so you could see better performance from the sector as a kind of a catch-up laggard as well.
All right. Hi, Sunil. Good morning and good to see you. When central banks are going to be in focus for this year, what are you all penciling in terms of Fed action? Since you're saying that the US economy could be stronger than anticipated, so what kind of rate cuts are you all penciling in from the Fed? And what about the RBI? How many rate cuts do we get out here?
Yeah, look, Nigel, I think we still are in the June cut camp. I think that the Fed rate cut cycle starts in June. I think having said that, so we're kind of penciling in 3 rate cuts this year. Having said that, I think that's one risk we are sort of closely
monitoring, because kind of we came into the year thinking that you'll have 6 to 7 cuts. Now that's already sort of down to 3 cuts. I think market is kind of also pricing in 3, although there is a active debate whether that sort of gets to sort of 2 cuts, depending on how the US data pans out. So I think that's one thing we're kind of closely monitoring. But as a base case, I would say we do think sort of Fed goes in June. We do think that we have around 3 rate cuts this year, another sort of the 3 rate cuts next year over the course of the next 12 months. So we see kind of central banks cutting across the board in most parts of Asia as well, barring obviously Japan and some markets like Malaysia, but pretty much everywhere else across the board. So that should be positive for equity markets. For RBI in particular, I would say, I think the key, obviously we expect them to stay on hold in the policy meeting later this week. Obviously they'll be probably sounding more optimistic on growth, commit the 4% inflation target eventually. But I think what's more from an RBI standpoint is what happens on the liquidity front. And barring the near-term policy meeting, our overall stance is that obviously liquidity was very tight in the system for the last 2 quarters or so. Things have already started to ease in the last month or so. So if you obviously look at both the interbank rate, but also the CD rates, they already started to ease off, right? So liquidity in the system is improving. Our own sense is that this quarter you will see liquidity easing much more, and eventually RBI starts cutting rates in third quarter of this calendar. But the rate cutting cycle, we think in RBI's case will be much more shallow. We are kind of baking in only 50 basis point of rate cuts. So it goes from 6.5 to 6%. So not a huge cutting cycle, but I think what's more important, what the markets will like, is the fact that liquidity is already easing, and we think more of that will happen in this quarter as well.
Sunil, I know the broad view is that you think rotation into large caps will continue, right? As you get closer to elections, is what you write in your report. You also highlight 10 or 12 names in the mid and small cap space where you think there is a fair bit of crowding in which has happened. But let me ask you on the other side. I mean, it's a large and now deep investable market in that sense. Deeper, it's all relative, of course. So highlight some names for us where you're still finding opportunities in that space, in the down the curve, market cap curve, which you've put out, where you've coverage and which you like. Yeah.
Yeah, look, I'll answer it 2 ways, Prashant, without getting into single names. I think one is that if you look at the broader market, I would say the theme of alpha still continues to play out in India, right? I think the first quarter we just went by is a good reminder of that, right? If you just looked at the mid and small caps obviously have corrected only 5 to 10%. If you look at Nifty, it's only up 3% or so. Probably MSCI India is up 7%. But if you look beneath the surface, right? I mean, there is a huge sort of a wide sort of dispersion between sectors, between stocks. I mean, just to give 1 or 2 examples, if you look at the consumer pack, right, you have discretionary outperforming staples by more than 20 percentage points in the last 3 months, right? If you look at, for example, commodity space, you have energy outstripping metals and mining and materials by 20 percentage points. So if you look at beneath the stocks, even in MSCI India, which is not just large cap, it's basically large cap plus mid cap, you have 40% of the stocks which have given double-digit returns. You have 30% of the stocks that are down for the year. So there's a huge sort of dispersion within the market which is already underway, on top of the entire rotations which you just mentioned, right? So we think the environment continues to be like that. Now, in the sort of value pockets, the way you asked the question, I would say there are still sort of themes we like within the market, and the way we kind of pick up the stocks is kind of where fundamentals are strong. These are buy-rated companies which our analysts like, and then they also kind of belong to one of the themes we have. So, for example, some of the themes we have been mentioning in our reports is this. You mentioned the rotation into large caps and the quality large cap names, but sort of beyond those large caps, there's also the theme of kind of high-end consumption, affluent India, as we call it. There is a theme of Make in India. There is a defense theme going on. We also are very bullish on the real estate cycle, and we think the best way to play that is through the building material or the late cycle construction materials. So if you go through these themes, I think there are enough themes within the market which investors can play. And then when you sort of look at the stocks, we sort of go with the analyst picks where we have the most conviction on.
Okay. I wanted your thoughts. I mean, I do notice that in some of the names that you own, right, some of the names that you've mentioned, whether it's RVNL, whether it's IRCON, something like a JBM Auto, these are in spaces that have grown very fast over the last couple of years, whether it's railways or EVs, etc. But you mentioned that now it's become a bit of a crowded trade, as well as valuations are expensive. So what do you do in these pockets? Do you sort of churn out? Do you continue to keep the faith here? What's your stance?
Yeah, look, I think within the mid cap, I would say, I mean, obviously the headline index is only 5 to 10% down, right? But that's, I think, masking the broader sort of deeper correction that has happened within these indices, right? So one of the things we also highlighted in the report is that if you looked at the sort of mid cap 150 stocks and the small cap 250, which is basically the 400 stocks beyond the top 100 names. So within those 400 stocks, more than half of them, so more than 200 stocks, have actually corrected double digit already, right? And there are some stocks that have corrected 35 to 40%, right? So there is some deeper correction that has happened in the pocket. And so obviously some of these stocks, as I mentioned, that still belong to some of the themes we like selectively. We do like those stocks. The stocks which we think are under risk, as you pointed out, are the ones where we think despite the recent correction, stocks are still more than 100% up in the last 1 year. So the price move has been very extreme. B, your valuations are running more than 2 standard deviations. So it's kind of harder to justify that things are, even the numbers are not in the price. And C, when you look at the top sort of domestic mutual funds, all of them are kind of owning the same stocks. These stocks also look pretty crowded. So that's one sort of pocket of the market, somewhat smaller, where we think it's worth kind of monitoring that risk, and probably there could be more downside there. But to your earlier question, if there are stocks that have already corrected, as I said, 30-40%, and we like them thematically, that's an area to build up exposure.
Okay, all right, Sunil, final question before we let you go. You know, the Chinese markets have bounced, but as you said at the start of this conversation, it's missing out on long-only funds, so that's important to note. But how do you play this entire commodity pullback that we're seeing? You know, metals move with momentum. Valuations, it's already, gone through the roof in comparison to, say, a 5-10-year average. But how are you all placed on Indian stocks, the metal-facing stocks?
Yeah, so we don't have sort of active coverage, unfortunately, Nigel, on the metal space, and so we kind of market weight that space. But I would say within the broader commodities sort of cohort, the way we are kind of placed within our allocation is that we like energy, so sort of refiners, obviously, and the index heavyweights there, which is not just energy view, but also kind of the telco plays and the inflection in capex and the free cash flows there. So we like some of the refiners and the index heavyweights in the energy space. We as I said, metals, we're kind of more neutral there. We do like, if you club utilities in the broader commodity spectrum, we do have an overweight on utilities, which is more a thesis around sort of peak power shortages happening and focus on renewables. So that's another way to play that. Where we are most cautious on within this sort of cohort is the oil marketing companies, where we think there is still pressure both on refining margins, but also on the marketing margins. And obviously these are kind of contra oil plays typically. We still think oil kind of is bouncing around at $80 on Brent. And there is sort of downside on the margins. And these stocks have rallied a lot. So we are kind of much more cautious there. So I would say, like utilities, like refiners, more neutral on metals, and cautious on OMCs.
Okay, well, thanks a lot for joining in, Sunil. Appreciate your time here. That's the word coming in on the markets and on individual stocks and sectors, what you can do ahead of the, the pre-elections rally, as well as the markets overall. But market, it could go either way, to be honest. For now, the market is sort of pulling back from the lows, but it's still down about 80 odd points. So it could be quite tricky the rest of the day. The one space that has been doing very well is real estate. Prestige Estates is the stock on our radar. It's up 217% in the last 1 year. The company has recently entered into a deal with the Abu Dhabi Investment Authority, which is ADIA, and Kotak AIF for 2,000 crore rupees via its subsidiaries. Now, with this deal and the money, they want to develop greenfield residential projects across various spaces, Bengaluru, Mumbai, Goa and NCR, and they are going, full throttle in the Mumbai region as well, as we know. Irfan Razak, the Chairman and Managing Director of Prestige Estates, joins us now to talk more about that. Mr. Razak, thanks for joining in. If you can tell us a little more about this fundraise, particularly with ADIA. Why did you go via the equity fundraise route and not more debt in the portfolio? And what is the plan that you have with the money in the residential space?
Morning, Sonia. Yeah, I mean, we are quite thrilled to do this transaction because we always believe less reliance on debt and more on equity is the way to go. And of course, this is a quasi debt. It's a blend of both. It's actually it's the first time that ADIA has directly invested into India, into any company, into real estate especially. And so that's a big one for us. This is, of course, along with in partnership with the Kotak AIF. I do hope this whole transaction, in the sense that, of course, the transaction has fructified. The only thing is, once we touch somebody's money, we definitely want to see that we give them good returns. And the projects that they have invested in, I'm sure they will do well. And what it has done for us is it's extended our bandwidth to do more work. And that's what is more important. And hence, we've got 4 large developments across the country, which they have invested in. And I'm sure all these 4 developments should do well and bring in plus for all stakeholders.
Can you tell us what exactly is the pipeline in terms of project additions? What are these large developments that you're talking about? Because I'm sure that a complete blueprint has been put in place, with both ADIA and Kotak AIF. So can you give us a little more details?
Yes, of course, because there is a large tract of land in Delhi, and then there is 200 odd acres in Goa, plus Mumbai. And then, of course, Bangalore also, there's a 22-acre plot. So all these, some are buy. Actually, Bangalore is a buy. Mumbai is a buy. And then again, in Delhi, it's a joint development where there's a large amount that has to be paid as a deposit. And of course, again, Goa is a buy. So these are the transactions that we'll be putting through. They all work in progress in the sense they've been tied up. It's not as though we are going into the market and looking for land. These projects have been tied up. They only need to get fructified. And this the money will provide the ammunition to close up these transactions.
4 of these, right, Mr. Razak? Morning. Congratulations, sir. Prashant here.
Morning, Prashant. How are you?
Very well, sir. So these are identified transactions, right? I mean, so ADIA knows what they're getting into. I mean, what the money is going to be used for upfront.
Yes, they definitely know. Without that, they wouldn't be playing blind. And they have done their due diligence. So that helps both the parties, ADIA, Kotak, as well as us, that there's some certainty. And we are only restless and, ensure that these transactions complete, fructify, we get the plans done, get the approvals, and go to the market with a launch.
Okay. The money comes into subsidiaries, right? The platforms created for the purpose of execution of some of these transactions. What is the revenue attributable over how many years, and what will Prestige's share be from these projects?
See, the overall revenue from these 4 projects should be around 18,000 plus crores. And as of now, since it's a structured transaction, we have an option at any point, if we have surpluses in these projects, to exit ADIA, the partners, at a certain given rate. So that's how it has been structured. But if they want to, they can go through to the end. So in fact, it suits us if we can do things quickly and have a good turnaround. We can exit them also. We've done that in the past with the HDFC fund. So I think the similar strategy we have in mind. And we are hoping that it all goes well. What it does is it will just give them confidence, give us confidence, and that will allow us to do and turn around more projects and gives us more ammunition for future.
But if they go till the end, let's just assume that they stay with you till the end, the execution of these projects, handover, etc. In that case, what are the terms of the deal in terms of what's the revenue attributable to you?
Yeah, it's again, then it becomes the bottom line profits. They definitely will look at, but as of now, what happens is, if you go to the end, it's whatever profit is there available is what is distributable on a 50-50 basis. But if it is not, then there's a certain return they look at, and we can return that money with that return.
What is that return, sir? Mr. Razak, hi, Nigel. Welcome to the show. Could you tell us what is that targeted return that these investors will be looking at?
Yeah, they are, in this case, they are looking at 16%.
16%. All right. So we've got that number out of the way then. Let's focus on other aspects of the business. Well, you're expanding big time in NCR. I think you had mentioned that you targeted close to around 3,000 crores from the NCR region by FY26, if I remember correctly. Do you think you can surpass this number?
I think it's a very conservative number. I believe that it's very doable. We've just tied up a large tract of land in, Indrapuram extension in NCR, and that's been bought. And I believe that will give us big revenue. Apart from that, we've bought a land in Delhi as a KG Marg, and now this transaction, one more, which is again in Kamla Nagar in Delhi. This is where the Arya money will go into. These are the ones that will give us quite a lot of revenue, including our old transaction, which was held up for some time, which now will get the approval, which will see the light of day, is our Sector 150 in Noida. So all these put together, if things go well and the market, the way it's behaving, if we do things right, it'll get us more than that 3,000 crores. But then we have to do things right. And of course, the atmosphere should be good. Approval should come. That's the important one.
Okay, so you could surpass that 3,000 crores of sales in the NCR region as well by FY26, right? I mean, that was your target earlier. You also had a target of 25,000 crores of sales by the end of FY25 overall. Are you on track to do that? Do you think you can, surpass that as well?
We have just started FY25. The teams are working on it. They're pretty bullish, and they are quite sure that they should be able to do it. It's a guidance that you have picked up in some conversation of mine some time back, but I think it's very doable.
Okay, I have one more question overall on what's happening in the Mumbai market, since now you guys are, getting, full blown now in the Mumbai market. Do you think prices could fall from here on? Because there is so much supply coming up. Now connectivity has gone up. So, the Navi Mumbai area outside of Mumbai in the MMR region also is picking up in a big way. Do you reckon that because of these two issues, higher supply and better connectivity, perhaps prices in the premium luxury part of Mumbai could fall a bit in the near future?
It's an amazing question, Sonia, because I definitely would like connectivity to, since connectivity has become better. What it does is it helps people to get a home which they've always been dreaming of at a reasonable number, which is affordable. And that can happen only if we can move a little away from town, from central Mumbai. But now, if you're asking me the question that whether in central Mumbai, since so much supply is going to go down, I mean, it's not gone up that much that it can go down. But I believe it will sort of peak at some point of time, because luxury is something where people will not want to travel quite a distance to because they can afford to buy. So they are different target audience. So whoever has got that bandwidth will definitely stay in central Mumbai and definitely pay whatever that needs to be paid to get a home of their choice. So here it's about choice. And the other part is about a need. And the need is, if I need a home and I'm able to get a home between my budget, that's that 1.5, 2 crores or 2.5 crores, the more I move away a bit from town, yes, I will do that. And that's where even if we're looking for volumes in that region, we should look at those areas and make sure that we concentrate there. While, of course, while we are doing and catering to the niche market also, it's a balance of both. We definitely cannot do more and more of luxury, because the market is, as we all know, is not that large, and there's always a bandwidth for that.
Okay, all right, Mr. Razak, all the best, and thanks a lot for joining us and talking about the recent deal with Arya and Kotak AIF. Let's slip into a quick break. On the other side, JN Gupta, former Executive Director of SEBI, and Karan Taurani of Elara Securities will join in to put focus on the cost rationalization measures taken by Zee Entertainment after the deal with Sony collapsed. Stay tuned for more on that.
Co-presented by
Welcome back. Well, the mid-cap index actually is the place that you need to be. The number of stocks advancing are close to around 2 stocks advancing for every 1 stock that's declining, and it's looking quite good as well. Advance decline ratio should come up for you on the screen. But let's turn our attention to Zee Entertainment. The stock had opened up mildly in the green this after they have initiated some cost rationalization measures. The company's MD and CEO, Mr. Puneet Goenka, announced a decision to take a 20% voluntary reduction in his pay. To discuss this, well, we have Karan Tarani of Elara Securities who joins us, and the former ED of SEBI, Mr. J.N. Gupta, who joins us on the show. Good morning, gentlemen, and thanks so much for joining in. Well, Karan, let's get first, how do you approach the stock? You know, these measures were something that the management has been hinting about, but what's your view on the stock?
Hi, Nigel. Good morning. So I think these measures are very much in line. So if you remember the last quarter, and after the deal fell through, the management did highlight that they want to really drive profitability. There is an intention here to drive EBITDA margins towards a guidance of about 18-20%. Currently, on a 9-month basis of FY24, the margins are very subdued at about 11%. So it's a long haul. A lot of effort will be needed in terms of execution, in terms of how these things pan out. But clearly, the intent is there, to improve profitability. And the stock could see the rating only based on execution and numbers and the financial performance. But of course, in terms of share price, one can't forget the fact that there's a lot of legal overhang on this company, and that will, kind of limit the upside from here on as well, because there are pending cases going on with NCLT. There are some issues going on with Disney as well, to that sports dishonoring of the contract. There could be some cater issues as well, with NCLT, with the pending cases that were there. So multiple legal overhangs which are there, and that could probably limit the upside. But if the execution on numbers is right, and if the performance is consistent, you could see some re-rating in terms of the upgrades.
Okay, you spoke about growth, right? The potential of growth, Karan, but what do you think the growth could be in FY25, considering that, of course, there is this large overhang? So I'm sure it's going to have some impact on their business. And the other thing is streaming competition has intensified so much in the last 1 year, right? Do you think that could be a hindrance to growth for them?
So from a revenue growth standpoint, actually, there's not much here because the linear TV business is not growing more than about 3 to 4% on a steady state. And if you look at the digital segment, there is ample opportunity to grow at about 25-30%. But unfortunately, the contribution to business in terms of overall contribution of digital is about 10-odd%. So blended basis, they would not foresee growth rates of more than 6-odd%. The delta will come only basis margin improvement, because if you look at their EBITDA margins, historically they were at 24-25% in the pre-COVID times after Z5 losses. And currently they're about 10-odd%. So if you look at the margin perspective, and if you see margin growth rate from here on, you will see better growth rate in terms of earnings. It could be 25% or 30% on this kind of a base. Secondly, in terms of competition, and we are seeing consolidation opportunities here. RI Disney coming together potentially, subject to the approvals going ahead. Competition definitely is going to increase from here on as we speak. And specifically on the digital side, Zee is more focused on regional, so they do have a cloud there. But I think Hindi GC is a struggle here. They're not present into sports, thankfully, so their margins are somewhere kind of protected as compared to Star and Disney, when margins are very, very low because of losses that they make in sports. So somewhere there is respite in terms of what the portfolio is there right now. What is the kind of trajectory of margin improvement that we can see?
Gentlemen, morning. Karan and Mr. Gupta. Mr. Gupta, the story of Zee, Karan was talking about the nuts and bolts, right? The business itself. But here there are other issues, right? There is, of course, the deal which, of course, fell through. There is regulatory angle to it as well. So we don't know the final outcome of what SEBI's investigations are into the alleged siphoning of funds. Zee, of course, has maintained that all those transactions have always been genuine. But we don't know. We've not heard the final thing from SEBI. If you can comment on that for investors, those will be very, very critical. And if you have any thoughts on what has been announced yesterday, which is that pay cut. Go on, sir.
Very good morning to all of you. See, as I don't comment on a stock price or what is the future of a stock, I can talk about the governance and everything else. See, today, if you look at Zee is fighting battles at multiple fronts. Earlier, it was only the issues with SEBI and all other things. And originally, it was Invesco versus Zee. Now it is a case that there are multiple litigation that is going on, a failed merger with Sony, problem with SEBI, then problem with Star and everything. So at that time, this is all negative things have accumulated in G stock. And at this juncture, the most important thing is that not only fight the battle, but at least create a perception that you are doing everything good. So while I will not be able to comment what is going to happen in G versus SEBI or G versus Star or G versus Sony, I can say that they are taking a small step to see that, okay, we mean business and we are trying to do everything that is possible to regain our past glory. Whether they are successful or not, that is a time will tell. But as on this step of taking 20% cut in the salary is a very small step in creating a perception issue, or rather clearing the issue that yes, we want to move ahead and we are realizing the problems are there and that's all. What is going to happen, none of us will be able to say.
Karan, I want to come back to that point you made, which is very important, right, about the overall business. A, the linear TV business is not growing, barely 3 to 4%, as you pointed out, and they haven't been able to scale up the digital business because of several reasons. What then would you do you think will happen now that we have a big behemoth, media behemoth forming in the form of Reliance Disney? What is the incremental potential downside that you see to Zee's business now?
I think in terms of downside, there could be a correction in terms of growth rates, right? So these growth rates, what I'm talking about for linear TV, the industry is probably growing at about 4% on the linear TV side, and adding digital is about 6%. So let's say if RL and Disney gain market share in the linear TV side, which is they grow faster versus market, which potentially they can because of the synergies and because of the big cloud that they bring. You could see them gaining market share, and at that case, you could probably see Z underperforming versus market averages, which means the growth rate of 4% becomes 2 to 3% on the linear TV side. On the digital side, there are concerns because clearly, on a distribution standpoint, Jio is going to become very strong here because of RR Disney coming together. They have very strong clout in terms of distribution. And that will limit the scale in terms of Z5, or even if, let's say, Z5 grows at 25-30% on this kind of a base, the losses may not come down very sharply because these platforms will have to invest into content. And that's what we've said earlier as well, that, once you have a large business, once you have a large digital business commanding more than 40% of market on the OTT side, these smaller players are going to find it tough to raise ARPUs, are going to find it tough to reduce ARPUs. To reduce the losses rather. So I think these are potential threats that one can see as far as Z is concerned.
Okay, Karan and Mr. Gupta, thank you so much for joining us and appreciate your time here on CNBC TV18. Well, let's shift focus now to Greenply Industries. The company has commenced manufacturing and commercial production of its functional furniture hardware. Manoj Tulsian, who's the Joint Managing Director and CEO of Greenply Industries, joins us now to talk about that. Mr. Tulsian, good morning and thanks a lot for joining in. If you can just tell me a little bit about this JV, right? What is the investment that you've made? What is the current capacity of the plant and what is the kind of revenue potential that you're looking at?
Good morning, Sonia, and thank you for having me on the show. First thing first, I think, we congratulated our team because this entire commissioning of this plant took place in a real fast time of just 5 months. So the groundbreaking started in November, and in March, here we are with the commissioning of the line also. In terms of the JV structure, it's a 50-50 JV structure. There is a Turkish partner who holds 50%, Summit, and we hold 50% in this. The board is equally managed. And these Turkish players actually brings in their engineering expertise, and we will bring in our expertise of sales and distribution here. In terms of the total investment, it will happen over 3 phases. Over 3 phases, we'll be closely investing around 250 odd crores between the two partners, and which will have like a 30-70 equity to debt. So at our end, we would be investing around 40 crores of equity in this, and the equal amount will come from our JV partner. Okay. And the third phase, I think, will depend on the ramp up of the whole business. But our first target is to complete the entire phase in the next 3 years.
So this functional furniture hardware, right? Can you tell us a little bit about what the opportunity size is here? How big is the market? What kind of growth are you looking at? And generally, how are the margins for this kind of business?
So Sonia, this business again is the high end of the furniture hardware, in terms of the hinges, the slides, the upper mounts. And this business in India will compete to the Hettich and Hafele of the world. Okay, so it's a high EBITDA margin business. The industry size today, the way we look at, is almost around $2 billion. And, it actually today is very similar to the plywood business in terms of the organized and the unorganized share. I think the organized share today is around 20-25%. But the way the upscale is happening on the real estate, in terms of home building, in terms of the customer demand, we feel that this percentage is only going to go up. People are more and more savvy to use good and high engineered products. And this business, we assume that on a full scale can throw a EBITDA margin of anything above 25%.
That's a sort of very good margin that you're talking about. An opportunity size, I mean, the market size is $2 billion, right? Already.
Yes.
These products can be sold through your existing distribution because you got to get this out there as well, right? Or you'll have to build something for this, different from what you already have.
So Prashant, it will be a mix. Okay, for us, it is a similarity in terms of these are also contractor influenced products. So it sells through the same channel, and you will see the new generation of plywood distributors and dealers. The new generation, once they have come, they want to make one-stop shop for selling everything under one roof and umbrella. In which case, our existing dealers are so excited about these products. Even if they are not selling, they want to start this as a dealership. So I would see that maybe 50 to 60% maybe a common dealer where we can get in very easily, and then the rest of the hardware channel, which is already there in the system in trade, is where we have to get in. The other advantage, what clearly we get is, Green Ply 3 years, 4 years back was only into plywood. We expanded into MDF, and we are running that successfully in the first year itself. Now we are getting into hardware. So, Green Ply, the tagline, which says Har Zarurat Ka Reply, we are also trying to create a one-stop shop that we are able to go to an OEM and are able to give them maximum number of products. Today, see, the transactional cost for everyone is very important. If an OEM has to deal with 10 vendors, their transactional cost is very, very high. We are trying to see that, how we can take many solutions to them, and, we save their time and we save overall transaction cost also.
Mr. Zultan, you said margins can be 25%. What about revenues for you from this business?
See, our ballpark calculation right now, these are estimations which has come from our JV partners. The type of facility what we are talking about, once all the phases are complete, this will give us a capacity on current prices of anything between 750 to 800 crores of top line at 100% capacity.
All right. Hi, Mr. Tulsian. Good speaking to you after a while. Nigel on this side. So basically, this asset turn is around 3 times, right? The investment. You'll put 250 crores and at peak you'll get 750 to 800 crores. Got it. So I think we've spoken enough about this business. Tell us about other trends. How's the plywood business doing? What kind of volume growth will you end up with for FY24? And what about FY25 on whatever you deliver in FY24?
So Nigel, a few things I think which is worth mentioning. Greenply was trying to do a lot of correction internally into the business, and we have been onto that journey. Plywood volumes during this year, we had given a guidance of 8 to 10% volume growth. We are right now on a 8% plus volume growth. And even for the next few years, I have been giving this guidance that, the volume will grow at anything between 8 to 10%. This is purely on the fact and the belief that, whatever internal corrections which we have done in terms of whether our policies or whether our approach to go-to-market strategies, whether our branding strategies and everything, and the team which is there at present will be able to deliver this type of a volume growth. If you ask me that what is the industry growth, truly speaking, we don't have that numbers. So we are looking at more as an intrinsic growth principle that there is an opportunity. The plywood market today is anything roughly around 30,000 crores. and we are just around 1,800 to 2,000 crores. So as a leader in the plywood industry, we still have a fair play to improve our volume. And if we get some more support from the government, because the unorganized portion is extremely high. The GST is today around 18%. And we all understand that the GST collections have picked up like anything. I am believing that there will be one more level of correction on the GST rates, and if the GST rates are dropped by the government, then possibly the shift from the unorganized to organized will take place.
What is the current GST rate, sir? What is the
18%.
current GST? 18%. Are you expecting it to come down to?
Well, we believe that actually it should be 12%.
Okay.
But
that's
but
on your
these are
wish
all,
list.
Yes,
So
that's a wish list.
Let's see how much of that comes through. The other smaller
But
part of
anyway,
your business.
Nigel,
the point,
even
sir.
if that doesn't happen, we are on the growth trajectory. And I think one more important initiative which the government is taking is the Make in India concept, and the BIS, norms which the government wants to strictly implement into this country. Though there is a deferment which has happened by around 10 to 11 months, but these are very good signs, where that low quality or the substandard plywood will no more sell into this country. The moment these type of reform measures keeps happening, you will definitely see that all the branded goods players are getting the advantage of the same.
Okay.
And we are prepared to get the larger advantage of the same.
Got it. So that's about plywood. What about the MDF business, the newer part of your business? Very small as of now, but how do you see that revenue scaling up? What do you end this year with for FY25 and FY26? Because there's big potential out there as well.
So, Nigel, first thing first, we commissioned the plant in 15 months. That was a very stringent target which we took, and we faced some challenges, because there was, when we initiated the journey, there were some pandemic hiccups also which were there. But, God has been kind. We were able to do it in 15 months. The ramp up has been very good. This is the first year of operations. We actually started selling from the month of June itself. Our target was somewhere this year to hit a revenue of anything around 350 crores in the first year. And we are very much on that target. In fact, we'll surpass that target. And next year, we are again looking at this whole turnover to grow by at least 50% from here, which means we will be able to use around 85-90% of the capacity in year two.
Just before we let you go, Mr. Tulsian, all of this expansion plan could perhaps put some pressure on your balance sheet, you think? Your gross debt is about 750 crores. But what are you comfortable taking it up to over the next 1 year?
So, Sonia, a few things. I always believe balance sheet management is very, very important. Before we embarked on this journey of growth, the first thing was that we corrected our balance sheet. And we had a cash of around 250 odd crores, which we used as an opportunity to first invest into the MDF plant and then also a plywood plant expansion. So today, if you really see, we are sitting on our India books a debt of around 500 to 550 crore. There's another 200 odd crore of debt, which still reflects on the books. But, that is with respect to our international business. And that business, we have been able to hive off in terms of giving the majority to another set of investors. So 225 crore of debt will no more reflect after March. So it will not even reflect in the March consolidated numbers. So technically speaking, we are now at around, we'll end the year, or we have ended the year maybe around 525, 550 crore of debt, which is around 0.7, 0.75, debt to equity. Our plan is to further strengthen the debt to equity because, with the margins, profitability going up, the net worth will improve significantly in the next 2 years. And we believe that we will bring down the debt at least by 100 crores in the next 2 years. So I think the debt equity will be extremely comfortable. At any point of time, we don't want to go beyond 0.5 as debt equity.
Okay. Mr. Tulsian, and that 750 to 800 crores at full capacity, which you said from the new business, that is by when, sir? If you can give us a
the capacity, Prashant, will, I think, will be on by in the next, I would say, maybe 18 to 24 months. Okay. But, this business, it is not so easy to ramp up the business because there are some large players who are sitting there. For us to build up this business, it will take a few years. But, as I said, that the margin profile is extremely good. And the product, the engineering, what we have seen is marvelous. They give a cycle which is even better than some of the other players who are selling into the market, the best names into the country. So we are very, very hopeful that our ramp up will be extremely fast.
All right.
And then we'll grow this business over a period of time.
All right. Wishing you all the best, sir. Thank you very much, Mr. Tulsian, for joining us and talking to us in detail about this new venture and, of course, your existing business on the ply and MDF side as well. Thank you very much. We'll take a break here. We'll come back and we put the focus on the first IPO of FY25, Bharti Hexacom. Rima will get us all the details. Stay with us.
Bharti Hexacom Limited.
Welcome back. Well, Mitesh Thakkar is joining in now to tell us what to do with the market. By the way, this is out and out a buy on dips market. Just look at that. Early morning, we saw a bit of a fall and now that's picked up quite a bit. In fact, the mid-cap index is in the green. Mitesh, what would you do? Is it confirmed now that, the best strategy is to buy this market? And if yes, what are the stocks to look at?
Sonia, the only thing which I have not been doing is buying the index because the Nifty and the Bank Nifty haven't given a breakout. But rest of it, I think we have had all buy calls. Yesterday we had SGX which was negative. Today we had GIFT Nifty which was negative. Today I think similar scenario and we have been buying. And today I think I did mention to buy on declines on the index. So we have advised our clients to do that. So yes, there is clearly long buys. A move about 22,530, I think will add to a lot of momentum. So I think then we can be slightly more aggressive tactically. But till then, buying the index and the stocks. I have a buy on Steel Authority of India right now. Buy with a stop at 146 for targets of 165. And the other one which I like is JSW Steel. It's giving a pullback, but the overall chart structure is very positive. So keep a stop below 852 here. Look for targets of 915.
Okay, all right. Thanks a lot for that, Mitesh. Well, let's shift focus now to the primary market. Telecom service provider Bharti Hexacom's IPO will open for subscription today. The issue is an offer for sale where the government entity TCIL will sell a part of its stake in the company. Rima is here to tell us more about that. Rima, over to you.
Thanks so much for that. So Bharti Hexacom, the first IPO of FY25 and also the first IPO from the Bharti Group in over a decade. The last one was Bharti Infratel, which is now known as Industars, way back in 2012. So there is considerable excitement. But let's get to the IPO details then. The IPO opens from the 3rd to the 5th of April. The price band has been set at 542 to 570, giving it an implied market capitalization of 28,500 crore at the upper end. Now, this is a pure offer for sale, which means no money will go into the company. Now, who's the selling entity? The selling entity is the Government of India, an entity called TCIL, Telecom Consultants India Limited, which will sell half of their holding. They have 15 crore share. They're planning to sell 7.5 crore share and overall raise about 4,200 crore rupees. Now, Bharti Airtel is the promoter. They have a 70% stake in the company, but they're not planning to sell any stake. Now, about this company. Now, this is your telecom service, telecom company. It provides mobile services, but unlike, say, a Bharti Airtel, Jio, Vodafone Idea, which are pan-India players, Bharti Hexacom operates only in 2 circles in India, Rajasthan and Northeast. Now, in Northeast, the company is a market leader with a market share of more than about 50%, while in Rajasthan, it's the second biggest player with a market share of about 40% as of December of 2023. The company was originally incorporated way back in 1995 as Hexacom India. Then in 2004, its name was changed to Bharti Hexacom Limited, which is when Airtel had acquired a majority stake in the company. Now, this company pays a management fee to Bharti Airtel for common marketing, admin, personnel expenses, and this is approximately about 1.7% of its revenues as of the latest numbers. Now, on to the financials. The company's top line has grown at a CAGR of 12.65%. So revenues now, as of the last year, stand at 6,580 crore. But the big positive has been the margin improvement. And look at the margin trajectory. Margins in FY21 were sub 25%, and they've risen to nearly 50% as of 9 months FY24. And the margins of the company have basically doubled. Yet the bottom line of the company has been fairly volatile on account of exceptional items. The big driver of the margin increase was a price hike, which took place about 2.5 years ago, which led to the ARPU of the company. ARPU's average revenue per user rising from 135 in FY21, 155 in FY22, and now it's nearly touching the 200 rupee mark as of 9 months of FY24. Now, it's a fairly big IPO, but what one needs to remember is that it operates only in two circles. So the customer base has not been growing at a very fast clip. Growth for the company is coming from upgrading its existing 2G subscribers to 4G and price hikes. Valuations then, now FY23 EPS of the company was about 11 rupees, which means at the upper end, we're getting a trailing PE of 52 times. So it's cheaper than Bharti Airtel, which on a trailing basis is at about 80 times plus. But remember, Bharti is much, much bigger in size. Bharti Hexacon's top line is about 6,500 crore. For Bharti Airtel, it's 1.4 lakh crore rupees. Back to you.
All right, Rima, thanks a lot for that. Well, let's dip into a quick break. On the other side, we get chatting with Max Layton of Citi to put focus on the commodity market. Stay with us.
Brought to you by
Welcome back, and the gold prices are trading at an all-time high, silver at a 26-month highs, copper at 11-month highs, and you have crude oil prices trading at a 5-month highs as well. So what better time to get Max Layton? He's Global Head of Commodities at Citi, and he joins us right now. Max, hi, thank you so much for joining us here at CNBC India. I want to first start with the Chinese data, and that really seems to be improving. The month of Feb was good. March, more or less, has been on the positive side as well. How do you look at these numbers now?
Look, I think it's a continuation of the trend that we've seen over the last year or so, which is that energy transition spend, energy transition investment in China continues to boom. So the renewable power additions in terms of generation capacity were very strong in the first couple of months of this year. And on the other side of the coin, construction activity has continued to soften. So, we've seen iron ore prices pull back 25 to 30% as a reflection of the weakness in construction activity. And we've seen copper prices, grind higher, and we think move into a higher range as a result of the energy transition demand and some supply issues on the copper side. So it's really, I think, a continuation of the theme that we've been seeing for some time now.
Max, I do understand that Citi has been bullish copper for some time, and we've seen all-time highs in China, 11-month highs on LME, 16-month highs in US for copper. How do you see the smelters output cut reaction in China?
Yeah, so I think a lot of people have been getting very bullish on copper, and you know what? We agree. Right, we've actually been quite cautious and often bearish on copper between May 2022 and the end of last year. So for about a year and a half, we were quite bearish or cautious. But we turned to tactically bullish copper, targeting 8,800 and potentially 9K at the end of last year in early December. And, now we're up at 88.9K. We had a big decision to make. Is copper going to pull back on a rising debt service burden, on a weakening global growth outlook over the next 6-12 months? Or is it going to continue to kind of grind higher, with the range shifting up over time due to underlying deficits and supply issues like those that we're seeing in China with the potential smelter cuts in the next couple of days and over the next few months? We decided that it's going to be the latter. We now think that, investors, we're strongly recommending investors have a position in copper, and we're strongly recommending that consumers of copper hedge their exposure over the next 1 to 3 years. It's on a path to 12,000. There's so many different ways to get there over the next 2 years, but that's where it's headed.
All right. So while you're talking about all-time highs in copper in the next couple of years, the ferrous metals clearly have not performed so well. Last year was a negative one. This year until now, the first quarter hasn't done so well as well. So how would you look at the ferrous metals, and do you see this constant pressure continue?
Sure. Yeah. So iron ore and steel, we're getting down to levels closer to cost support. I don't think we're there yet, but so on the iron ore side, down at $100, and towards the end of the year, the backwardation in the curve takes the price down into the 90s. In prior cycles over the last 4 or 5 years, and certainly based on our cost curve work, you normally get support in the $80 to $90 range. So having fallen about 35% over the last few months, you're around 10% or so away from historical lows and cost support. So we're getting there. We're not sure it's the right time to get in right now, but we're really close, and we think we'll get there down to $90 or so over the next month or in the coming weeks. At which point we think it's going to be a fantastic buying opportunity on the iron ore side. Steel, I think we're more neutral. Range bound market's been range bound for a very long time. We're not really expecting that to change.
I want to come back to the non-ferrous metals, and here the aluminum prices are trading at a 3-month highs. Nickel has been under pressure. Tin continues to take its cues from whatever news comes out of Indonesia. So barring copper, which you are very bullish on, what is your sense on the rest of these non-ferrous metals?
Yeah, I got to say copper's the one that we like. The other ones are underperforming, in part because they're just not attracting the same excitement as copper. So the relative positioning from investors is weighted towards copper. So whenever people think that the world might start to, the Fed might start cutting rates and we might have a turn in the manufacturing cycle, the chosen way to express that view is copper. And it's not the others and coppers. So copper positioning's maybe 6 or 7 out of 10 on the last 5-year range, whereas all the other metals are around 1 or 2 out of 10. Our least preferred metal, so we're most bearish on nickel. We published our quarterly outlook, our slide deck about a week and a half ago, and in that we said that investors and producers should sell nickel at around $18,000. It's come down to around 16,500 at the moment. We think there's more to go. It's going to come down to around 15.5 over the next few months, and that's where we kind of expect it to settle. This market is burdened by substantial supply growth, particularly led by Indonesia, and so we think it's the big underperformer. Aluminium, hey, look, we're medium-term bullish on it, and eventually it's going to have its time in the sun. We're just not expecting it anytime soon. Broadly balanced market. People are not really truly believing in a global recovery en masse, so they're not willing to put on the aluminium leg. They'll put on the fear of missing out trade in copper, but they won't put it on in aluminium, I don't think. But eventually, when global growth does turn, let's call it 18 to 24 months time, there's practically no supply growth in that commodity, and aluminium's gonna have a good run. We think it'll get up to, on a 2-year view, we've got it coming up to 2,900, which is some pretty substantial percentage upside from 2,300. And zinc, largely neutral, trading the range. We're just getting tactically bullish down at 2,300 and getting tactically bearish up at 2,600. And, we'll kind of expect that to be the story of the next couple of years in zinc.
And Max, I do want to talk about the gold prices. All-time highs every single day for last 10 trading sessions. Now we are almost inching to that $2,300 per ounce mark, forgive me. And silver has been surging as well. How do you look at the precious metals from here on?
Yeah, we're loving it too. We're on the bandwagon with gold. I think you only have to go back to the second half of 2007 and look at that Fed cutting cycle when it cut from 5 to 2%. And how gold and silver performed during that period. And we're expecting something of a rerun of that over the next 6 to 12 months. So we've got gold hitting new, fresh, all-time highs, 2,300 an ounce. And we've got silver, even on a 6-12 month view, outperforming gold. Silver doesn't just have the Fed cutting cycle on its side. Silver's also got very strong demand from solar and from EVs coming, led by China, but also globally. So we've got silver getting up to $30 an ounce over the next 6 to 12 months. So certainly we would recommend, dip buying over the next month or two as the market digests this really big inflow of funds into precious metals over the last couple of weeks.
And Max, there's a lot of action in energy as well, especially with the conflict widening now in Middle East, with more countries getting involved, and the crude oil prices are now trading at a 5-month highs. I remember you saying that it's going to be difficult to be bearish in crude. And what is your sense then for prices from here on for the rest of 2024?
Yeah, I think one of the most popular trades or views in the oil market is being bearish volatility or being short vol. And this is a reflection of the lack of fundamental deficits or surpluses, the material deficits or surpluses that people see over the coming quarter. So essentially, people are generally not expecting much to happen, and we're in agreement with that. We think prices are going to be pretty neutral at around the $80 mark over the next 3 months on the Brent side. We think it's a very difficult market to be bearish because of the fact that the situations that you mentioned, and obviously with President Netanyahu saying that he will intends to go into Rafah, that suggests that there is a room for material escalation and tension over the coming months, right? So very difficult to be bearish, even if you do have a surplus like we do in our balances in the second quarter. But looking further out, maybe not for the second half, but certainly into 2025, you've got these big structural stories in crude oil. You've got weaker demand growth coming from the cycle, from the global cycle. You've got higher efficiency in terms of automotive use of oil. You've got EVs taking massive market share in China, which is reducing Chinese demand growth. And you've got very broad-based, strong supply growth, especially as prices trade at $80 plus over the next 3 months or so. You're going to have very broad-based non-OPEC supply growth over the next 12 to 24 months. So 2025, we're very bearish, actually. We think the vast bulk of scenarios point to lower prices in 2025, and we have an average price forecast of $60 in 2025.
All right, that's an ouch for the producing countries. But when you talk about 2025, Max, would a lot depend on where the dollar index is, what the US Fed has done until then in sense of rate cuts, with European central banks also talking about rate cuts. How are you approaching the second half of this year?
I mean, I'd say a standout dollar view is we've got dollar-euro going to parity in the second half. When I say we, I mean Citi as a house. And that's essentially on the basis that US kind of outperforms Europe essentially on the growth side, and therefore and on the inflation side, and therefore policymakers cut rates during the second half at a faster pace in the Eurozone than they do in the US. And so that's probably our standout view. I don't think that's going to be a big headwind at all to precious metals, although it does, it takes out some of the upside.
All right. Max, a final question, and this one is on agri-commodities. And while everything else seems to be consolidating, it is cocoa which is on fire, up 125% alone in this year itself.
Yeah, cocoa's on fire. Amazing move in that market. It just shows you what commodities can do when you get inventories down to critically low levels. And yeah, I mean, it reminds me of 2003 in copper when you ran out and the price went up 5 times. Similar things happening in cocoa. Look, my colleague Akash does some great work on ags, and he's been bullish most of the way up. He's staying bullish in the short run, but I think we're more looking on the cocoa side. We're more looking when to get out at this point, because I think there's going to be a lot of opportunity for investors on the way down. Calling the top's very difficult, but we think we're close to a turn at some point in the next couple of months.
All right. Max, thank you so much for talking to us at CNBC-TV18. It's a pleasure as always. So that's the view coming in from Citi. Going forward, it's all-time highs for gold and copper. Silver can outperform gold is what Citi says. And when it comes to cocoa, well, selling perhaps is the best strategy from here on. But that's all the time that we have on Bazaar. Chartbusters is up next.